Hi, morning, guys. Can you hear me okay?
Good morning, Cole. Can you hear us?
I sure can. Can you hear me?
Talking, but we can't hear him. One more time for me.
Yeah, sure. Can you hear me okay now?
Yes, we can. Thank you.
Perfect. Is my video okay?
Yes, it is.
Okay, great. Thank you, guys. I appreciate it.
Thank you.
Um,
Good morning, Kevin. Can you hear us?
I can. Can you hear me?
Yes, thank you. Good morning, everyone. This is Mackenzie Sykes with the ASRS. Thank you for joining us. You're nearing the scheduled start time of the investment committee meeting. Please be patient when we confirm that our virtual participants are online. Thank you. Good morning, Jay. Can you hear us? Jay, are you able to hear us? I did check it. That's fine.
Hello, everybody.
Good morning. All right, if we are ready to get started, Chairperson Pekunis, the time is 9:33. We are ready for you to start at your discretion. Once you've called the meeting to order and the official roll call has been taken, I would like to take a moment and review the meeting guidelines. Thank you.
That sounds great. Yeah, let's go ahead and call the meeting to order and take a roll call, please.
All right, will the following individuals please confirm you are present at the meeting by stating here as I call your name? Jay Pekunis,
Here.
Diane Landis,
Here.
Kevin McCarthy.
Here.
Perfect. Chairperson Pekunis, a quorum is present. I would now like to read the guidelines and reminders. This meeting is currently being recorded and live streamed to the public. All speakers, please remember to identify yourself before speaking. Unless you are speaking, all mics should be muted to eliminate background noise. All cell phones should be set to silent. Once motions are made, I will take the vote by roll call. Once completed, the committee chairperson will announce whether the motion has passed. This will ensure it is clear to the public how each trustee voted and that the minutes are documented accurately. All presenters, please refer to the page numbers of the packet as you move through your presentation so that the attendees can follow along. If any members of the public wish to speak, you'll have the opportunity under the call to the public agenda item 8. At that time, the committee chairperson will ask if any members of the public have requested to speak, and I will read the names of each person who have indicated that they do. Thank you.
Sounds good. Thank you. With that, we'll move on to item number 2 of the agenda, which is approval of the consent agenda. All items under the consent agenda are considered to be routine or have been previously reviewed by the board and board committees and may be considered for approval as a single action unless a board member wishes to remove an item for independent review, discussion, or possible action. Hearing all of that, do we have a motion to approve the minutes of the December 18th, 2024 public meeting of the investment committee?
I move to approve the consent agenda.
Kevin McCarthy, I second.
Thank you. With that, can we take a vote?
Hearing a motion by Ms. Landis and a second by Mr. McCarthy, I will take a roll call vote for the motion to approve the consent agenda. Please answer aye or nay when I call your name. Mr. Pekunis,
Aye.
Ms. Landis,
Aye.
Mr. McCarthy.
Aye.
Chairperson Pekunis, the vote has been taken.
Okay. We're motoring through. With that, we'll move to item number 3 of the agenda, which is a presentation, discussion, and appropriate action regarding the investment management environment, outlook, and independent reporting, monitoring, and oversight for the period ended December 31st, 2024. And I think we've got Ms. Rose Dean from NEPC to walk us through that.
Great, thank you. For the record, Rose Dean, partner at NEPC. So today we'll be going through the fourth quarter investment oversight report, and we actually presented the updated fourth quarter market environment at the last board meeting, so I'll be relatively brief here. But if we turn to page 12. Great. So this is a summary of the market performance as of the end of the year. As I mentioned at the last time, it was a year where across the board investors took advantage of the market returns that were across the board relatively positive, with the exception of the real estate sector. One thing to highlight here is that this was another banner year for U.S. equities, delivering another year of mid 20% returns, and some parts of the market more than 30% returns. So this had a large impact, particularly as we'll go through in the oversight report, the benchmark mismatch between the public equities benchmark and the private market. So we'll go through that in some detail. International equities were not as successful as U.S. equities, but we are seeing year to date in 2025, international equities actually rebounding and outperforming the U.S. equities. Across the board, as I mentioned, it was a positive year. That's a different story year to date in 2025. Stock markets are down about 1 to 5%, depending on the parts of the market quarter to date. The sell-off is really focused on large growth stocks or the Mag 7s that really led the rally for the past several years. There are obviously concerns about U.S. policy implications, such as tariffs and the likelihood of potentially recession. But our research team believes that the impact of these tariff policies on the economy is likely to be subdued unless there are some significant disruptions to the supply chain, and that is still yet to be determined. And we'll get more information next week when we hear about the retaliatory tariffs. I will just remind the committee, obviously, we're seeing a lot of volatility in the markets, but the important thing to focus on is that the plan, it has a long-term horizon, and the long-term positioning of the portfolio to generate the necessary returns over that horizon should be the focus rather than reacting to the short-term volatility. And this perspective will be important in our discussion later on the asset allocation recommendation. So with that, I'll turn to the oversight report on page 26. So on this page, we show, as usual, your investment objectives as specified in the strategic plan and the extent to which these objectives have been met. And the comments show the details as to how these goals were achieved. As of the end of 2024, you see that objective number 6 with respect to cash management has been fully met, but the other objectives are partially met. So this is a common theme across the portfolio objectives and the performance that we've been discussing for the past year. So you'll see that across these objectives, mostly the 3-month and 1-year period, so relatively short-term period, the objectives were not met, but these objectives were all met in the longer term, particularly 5 years and longer. So this is an important thing to keep in mind for portfolios such as ASRS, where there are meaningful allocations to private markets. But across these objectives, 1, risk-adjusted return, 2, being in the top quartile among peers, return above assumed rate of return, and asset class returns versus their respective benchmarks. These have all been met over the longer term, and I'll go through in more detail in the subsequent slides. We'll start with page 28. So again, just to orient you to the graph and the table here, the graph shows in the dot the ASRS total fund performance, and then the triangle shows the interim strategic asset allocation policy and where they rank within the peer group of public funds greater than $1 billion. You see the returns in percentage terms, and then the numbers in the parentheses are the ranks within that peer group. So the total fund return for the 4th quarter was actually negative 13 basis points or 0.13%. And then for the 1-year trailing period, the return was 7.98%. The portfolio underperformed the policy benchmark for that 3-month and 1-year period. So we've noted in these reports that there's this benchmark mismatch between private asset classes and the public markets benchmark. So I think this slide actually shows how drastic that short-term impact is. Because if you look at the benchmark performance for that 3-year and 1-year period, and you see that number in the parentheses, basically this benchmark was at the top of the entire peer universe for the 3-month period and top 5th percentile in that entire peer universe. So really very difficult to outperform that benchmark. That story changes very quickly if you go out just to 3 years or 5 years, which includes the 2022 when the stock market was down 20%. And then you see that the benchmark return is in line or lower than the ASRS portfolio return. So as you're aware, it takes time for the private markets investments to realize the values. When we look at the longer term returns, we don't see this kind of short-term mismatch. So as a matter of fact, later on, when we are making recommendations in our asset liability study, we will be making the recommendation to change these private markets benchmarks to the peer universe benchmark that you've already incorporated as a secondary benchmark.
Before you move on, just quick question, Ms. Dean, just clarifying. I always get this confused and it always takes me a moment to reacclimate. On the interim SAA policy, that's the benchmark performance at our target allocation. So what the total fund, so the triangle, do I have that correct? The triangle represents the benchmark at what our stated asset allocation is. The circle represents our actual performance at our actual allocation. Is that right?
That's correct.
Okay, thanks.
So if we, again, to look at the longer term periods, the portfolio is actually outperforming the benchmark and is in the top quartile among the peers. For the 10-year period, the total fund return was close to 8% versus the 7% return for the benchmark. And then for the 20-year period, the portfolio return was 7.27% versus the 6.66%. So you are actually achieving returns that are above the hurdles set as the policy benchmark. So your objectives 2 and 3 are being met for the longer term periods, as well as objective number 4, exceeding the assumed rate of return.
One more quick question for you.
Sure.
On the 1-year performance, is all of that, obviously it's clearly different than for all other periods. We're kind of top quartile, top decile, in some cases above the top decile. For the 1-year rankings, is all of that, or how much of that kind of underperformance relative to our 3, 5, and 10-year performance is a function of the lag in the benchmark for credit and private equity versus other? And maybe you get into this in another slide in more detail, but how much of that would you attribute to the lag relative to the benchmark versus underperformance in the other asset classes?
Sure. I think it would be beneficial to turn to page 35 here, just so that you see the extent to which the difference between the public markets benchmark and the asset class in terms of private assets performances. So if you look at that 1-year return for private equity, the ACWI IMI, or the public markets benchmark return, was 31%.
Yep, I got it. Yeah.
And then the portfolio performance was, or the composite performance was around 5%. And if you look at that in the context of the actual allocation of private equity, which is about 13% or slightly less than 13% in terms of actual allocation, that 26% underperformance is contributing, at least 3% to the underperformance versus the benchmark. And then similar story on the credit side. There's about a 4.5% underperformance on a 22% allocation.
Got it. Thank you.
Sure. So I do want to spend just a minute on page 31 to look at the risk-adjusted return statistics, given that this is one of your objectives. And we'll look at the 5-year risk-adjusted return. The 5-year portfolio return is at 8%, and that exceeds the benchmark performance of 7.85%. And that portfolio, or the total fund performance, ranks in the top 13th percentile among its peers. But if you actually look at the median performance, the median fund in this peer universe return was only 6.9%. So you've significantly outperformed the median fund return. And as the story is relatively consistent, as you've heard in the previous reports, you rank towards the bottom in terms of volatility, meaning you are less volatile in just one measure of volatility using standard deviation of return here. So your risk-adjusted return in terms of Sharpe ratio based on that volatility of return metric, you rank in the top eighth percentile. So again, we're not focused on just these metrics in terms of risk, but this is one way to look at whether the volatility or the risk being taken in the portfolio is being translated into return. And this is one way to look at that. And you are actually doing in top decile amongst your peers.
Thank you.
And then I'll actually just quickly turn to page 38 for asset allocation compliance. So we are going to talk about your asset allocation recommendation after this, just as a context of where you are right now. At the end of 2024, your portfolio value reached $56.78 billion. That is a slight decrease of about $300 million from the end of third quarter, but from the start of 2024, when the portfolio value was $53.5 billion, so there was a net gain of about $3.3 billion during the year. So at the end of the year, you see the private equity was slightly overweight, about 2.75% versus the 10% target. The interest rate sensitive is underweight by 3% versus the 6.6% target. And real estate is now very close to the 17% target. And you'll recall that this allocation was brought down successfully towards this target this past year because we were at about 20%. So lastly, I'll just turn to page 42 in terms of the summary of the asset class meetings. Again, this is the staff investment committee meetings, and NEPC is a fiduciary oversight at these meetings. During the fourth quarter, there were 7 committee meetings, including one virtual one or email meeting on the 31st of December. And then there were 10 manager recommendations across private equity, credit, and real estate that were approved. So that concludes our oversight report. I'd be happy to take any questions you may have.
I just had, I have one question, but I'm not sure it's, with Govenda, I'm doing everything electronically, and so it's hard to follow my notes. But on the, when we went through the real estate, I was just looking at the real estate update. Hold on, give me 5 seconds to find my bearings and get my bearings and make sure I'm in the right place. You know what, I'm going to wait till we get further along to item number 5 in Govenda, 5C, as we move a little bit further down. So I'll hold off on my questions.
Great. Okay. Anything else?
Nope. Any other members of the committee?
Not here, Jay.
All right. Well, anything else on item number 3 from anyone, staff or Rose, before we move on to item number 4?
Nope, all set here.
Okay, well, let's move to item number 4, the presentation, discussion, and appropriate actions regarding the current asset liability study.
Hey, thank you, Chairperson Petunis. I'm going to give background information before we go right into the study. So we're really going to have three participants in the presentation. It will be myself and Mike and Rose. So I think I'll start out and then Rose will take it from there, and then Mike will interject comments as we go through them. But basically what I want to start out with background, because there's a lot of numbers and a lot of analysis. So as follows. Number one, we do this every several years. If you went back 10 or 20 years in the US, you probably did it every 4 to 5 years. Now we tend to do it every 3-ish years. And what it does is it creates a portfolio that is strategically optimized, from which you then make tactical movements on a daily or weekly or monthly or quarterly basis. So it gives you that sort of expected optimized portfolio. And when we think of creating that expected optimized portfolio, we think of optimizing in terms of long-term rates of return, and then we mitigate or modify by what we perceive as the risk. Most entities will think of risk, sort of the academic risk, as the standard deviation or the up and down movement of the portfolio. So that is one way of thinking of it. We think of it a little differently. We do consider the up and down movement of the portfolio, but we also consider, perhaps more significantly, how we want to mitigate the volatility of our contribution rates while optimizing the long-term growth of the portfolio, which drives down future contribution rates. So there's a lot of tools, not just in the investment world, but on the actuarial side, that allow you to mitigate contribution rate volatility. So it's one of our house views is to only focus, if you were to only focus on your investment portfolio to mitigate rates of return, you are likely, or mitigate volatility of contribution rates. If that's what your focus was, you're likely to come up with a relatively risk-averse portfolio, but a relatively risk portfolio will likely have a lower long-term average rate of return. So rather than decrementing expected rates of return by having a less volatile portfolio, if you incorporate portfolio volatility with actuarial tools such as smoothing and amortizations of deficits and so forth, if you aggregate these together, you can actually create a portfolio with a higher long-term rate of return, but still have a very mitigated standard or mitigated volatility of contribution rates. So number one, we do this about every 3 years now to come up with a normal portfolio from which we deviate on a periodic basis. Now, that's number one. Number two, process assumptions and preliminary recommendation I want to go through. That you can see in the analysis that we have really 3 different types of rates of return. It would all be fantastic if we had one set of returns, but we don't. So what I want everyone to be aware of is this is an investment construct and not an actuarial sort of debate or discussion. The two are linked, but when we come to when we look at the rates of return and the rates of return assumptions, that's not going to be incorporated into our funded status or our go-forward contribution rates. So this is a different way of thinking than what the actuary would do. If the actuary came in and came up with an expected long-term rate of return, we would think, aha, that's going to change our funded status. And as a result, it will change our contribution rates. But that's not what's happening. We are now presenting a series of numbers that will augment the construction of the investment portfolio. And if those rates of returns that we're using to augment the investment portfolio are, for instance, better than what we've assumed in the actuarial work, that will flow through, but it flows through time. So you have to earn those rates of returns before they flow through into lower contribution rates. So we have 3 sets of rates of return, or what are called capital market expectations. NEPC has sort of a set of expected rates of return they use for their clients. We then have an expected rates of return from ASR staff that in a couple of key areas are a little different. And then there's a third set of aggregate expectations, and that would be GRS or actuary. So we're not talking about the actuarial set of assumption, which is effectively a 7% long-term rate of return expectation. We're going to, Rose is going to present what NEPC believes and then what ASRS believes long-term rates of return. There are 2 differences, key differences in those long-term rate of return assumptions, and it has to do with public and private equities. ASRS staff is more bullish on public and private equity rate of return expectations than NEPC. So those are the two key things. So all these pages of numbers and appendices, where's NEPC fundamentally different than staff with go forward expectations? It is with public equities, like the stock market, and private equities. That explains the deltas between what we think are house views and NEPC. Now, the next thing is outcome. So we haven't done the presentation, but I'd like to share what the outcome of the presentation is so you know where we're going before we start the formal presentations. The outcome of the presentation actually is fairly modest changes from what we have. It is simply reduce real estate target allocation by 2%, reduce credit target allocation by 1%. So that adds up to 3. Reduce real estate by 2, reduce credit by 1, that adds up to 3, and then take that 3 and put it in private equities. That's the change. And then on the benchmark side, we are recommending a change in benchmarks in 2 areas, and that is private equity and credit. And we're migrating from a public market benchmark to, in those 2 cases, private market benchmarks. We think that, and Trustee Petkunas has raised that a number of times. There's multiple ways of looking at benchmarks. The fundamental considerations with benchmarks are that they should be investable, they should be reflective of their portfolio construction, they should be appropriate, pre-specified, unambiguous, and measurable. Those are sort of the fundamental building blocks on the characteristics of benchmarks. One thing we have done, and I think we maybe put a lot of weight in it, and that is looking at opportunity cost. When you take $1 from, for instance, public equities and put it into private, a lot of people will compare the two. And that's really an opportunity cost analysis. It doesn't really reflect how well you did with a private equity allocation. So what we're going to recommend is for private equity and credit, we migrate from public market benchmarks to private market benchmarks. That makes the relative performance of those asset classes easier to measure and to understand. So that's the background information. If it's all right, I'm going to turn over to Rose now with NEPC.
One question, one moment before Rose, before you start on your presentation, just a quick question for you, Paul, on the contribution rates and how often are contribution rates adjusted based on the actual realized rates of return or functional rates of return, not actuarial rates of return?
They are adjusted every single year, but not with a full flow through. So there's different ways to sort of smooth your rates of return to have the delta between your actual and your assumed rates of return flow through to contribution rates. Mm-hmm. In the extreme, you could say you do that every year. If you did that every year, gosh, your contribution rate volatility is likely going to be quite high.
Yeah.
The other is extreme is you don't do it for a long, long period of time. The norm, or the median, I should say, the median in the United States, and I'm going to look at Robert in case you want to modify that, the median in the United States is probably around 5 to 7 years.
In terms of smoothing period?
Yes.
Yes.
Yeah, about 5 to 7 years. We do it over 10 years. And that in our way is one way of getting a mitigated contribution rate volatility, but still have a reasonable amount of time for those the difference between the actual and the expected rates of return to flow through to the portfolio. So the answer would be it flows through every year, but approximately only 1/10 every year.
I got it. So you're smoothing over 10 years and making the adjustment to the contribution rate based on that smoothed on the smooth data.
Yeah. So every year, what our actuary will do every year on a go forward basis until we change the assumed discount rate on our liabilities that GRS uses, which is currently 7%, they're going to reevaluate the liabilities at 7. And then they'll look back a year and say, oh, you out or underperformed. They'll recognize a portion of that. They'll look back 2 years. Out or underperformed, recognize a portion of it, all the way for 10 years, and then incorporate that. So they'll do the analysis based on 7% and then add or subtract based on history over a 10-year period.
And Paul, that 7% actuarial rate, has that moved around much, or is that pretty constant over time?
Yeah, interesting. I'm going to go way back now. When I first moved to the US, it was 8%, and it was just pre.com. And we were criticized a number of times for being so low. I I remember I was speaking at a group of our members, and there's several hundred of them. And I was asked what a long-term rate of return expectation was, and I said approximately 8%. And I had one member say, that's simply not appropriate. It should be somewhere around 20 or 30%. So we went from a world where people thought 8% was much too conservative pre-dot-com crash. And then as you went into post.com and then post 2008, folks looked at the 8% and said, look, it's going to be hard to make the 8% either for one of two reasons. Historically, the institutional investment world hasn't made 8% for several years, but more importantly, maybe the economy had been restructured. Therefore, on a go forward basis, the 8% was hard to make. So basically the US has gone from a median modal average of 8% approximately 25, 30 years ago to now approximately 7, or as of today, it would be about 6.9%. So the average right now as of this second is probably 6.9%. It's different in other countries. A lot of other countries will build in what our insurance companies do. They'll build in a risk spread, and they'll say, look, we think you can make 7%, but we're very risk averse. On a go forward basis, we're going to discount our liabilities at say 6%. So that's typically not done in public funds in the US.
Got it. Thank you for that.
Thank you.
Paul, can you use an example of the smoothing? I think it's important. So we use 10-year smoothing. Let's talk about fiscal year 21 and 22. The ASRS had a pretty strong return in 21 and then not so great return in 22, and how that flowed through to the contribution rate.
Yeah.
I think those are great examples.
One thing we've had on our, I'll call it our house view and a corporate agenda for over 2 decades, is to mitigate contribution rate volatility. If you go back to the late 90s and early 2000s, our contribution rates changed from like 7 to 2% over several years. So from 7 to 2%.
Jeez.
So and 7% was sort of the long, if we stayed at approximately 7%, our contribution rates would still be at approximately 7%. There's multiple reasons we're at 12% now, but one of them is because we used to be at 2%. So the more you can keep them hovering around what your real long-term reasonable expectations are, the less likely you're going to have them really high or alternatively really low. So if you go back, say 20 years or 25 years, you would see significant contribution rate volatility. And we had a house view of how to mitigate that. We thought through it and decided that, look, you can construct a portfolio to have less volatility, but man, if you do that too much, you're going to drive down long-term expected rates of return. So what other tools do you have that, as long as you're unbiased in your expectations, these tools will mitigate volatility, but not drive down expected rates of return? So as long as you've got reasonable expectations, and the two that we had, the two main ones were to average our rates of return over, and this is approximate terminology, but average our rates of return over 10 years. So every time there's a delta in rates of return, expectations from reality, you absorb that a little bit each year. And then the deficit or surplus gets amortized over a period of time. So you don't pay that deficit or surplus off every year. And ours right now is 20 years for the pension plan and 15 years for the health insurance plan and 15 years for long-term disability. So those are the periods that we amortize our deficits or surpluses. And the reason you want to do that over an extended period of time, again, is if you did it over short periods of time, your contribution rates would have to go like this. So in order to mitigate your contribution rates, if you have reasonable long-term expectations and they're reasonable and you expect to achieve them, you can actually get what we think of as a free lunch on volatility. And you do it by making certain assumptions and using certain methodologies on the actuarial side. That significantly mitigates those volatilities on contribution rates. Now, the end result, Mike, is if you look back several years, we had a total fund rate of return of approximately 25%. Do you remember that? And a lot of folks said, hey, 25% rate of return, that means your contribution rate is going to fall like a rock. No, that didn't mean that. We are absorbing it over a 10-year period. Our contribution rates fell approximately 0.2%. I believe it was the year later, we have a rate of return, Mike, I think it was approximately 1%.
A little less than that, but above zero.
Yeah, so approximately 1% rate of return. And then folks would look at that and say, well, hey, you thought you made 7 and you made 1. I guess contribution rates will go up a lot. Actually, they fell about another 0.1%. So by using this methodology and the long-term expectation, which is really interesting, the long-term expectation for contribution rates for the system is 7%. In approximately 20 years, our expectations are, and these are using GRS, actuarial 7% long-term rate of return expectations. So using this 7% in approximately 20 years, the contribution rates for the ASRS will be 7% for the employee and 7% for the employer, and lower if we go with either NEPC or staff expectation of rates of return.
Got it. That's really helpful. Thank you.
Thank you. Thank you, Mike.
Thank you. So, Rose?
Great. My up, okay. All right. So for the record, Rose Dean, partner NEPC. I'm joined by my colleague Rob Goldthorpe, sorry, Senior Investment Director on the Asset Allocation team. I'll be focusing more on the asset side, and Rob will talk about the projections that incorporate your liabilities. So before we get into the meat of the presentation, as Paul mentioned, the asset allocation or asset liability study is conducted every 3 to 5 years. The last one you conducted was in 2022. And the board made some impactful changes to the portfolio that's been really additive to the plan, notably increases in equity allocation and credit allocation, and then decreases in interest rate sensitive and real estate allocation. Just to sort of round out that comment, why do we do this every few years? It's because, as you're well aware, the investment landscape changes, the drivers of return and the outlook for those return drivers, such as valuations, change. So we sort of update our outlook and the assumptions for these asset classes and refine them so that we can have a better idea as to going forward, what is the the best potential risk-adjusted return or the trade-off between return and risk. But every asset allocation study, I just like to emphasize 2 points. One, that your decision on the asset class allocations will drive plus 90+% of the outcome of the portfolio. So this is a very important driver of how ASRS will perform going forward. But two, as I mentioned before, and this has to do with the longer term horizon of the plan, that we keep a horizon that is not moved by our day-to-day volatility in the capital markets, but to say, here's the big picture return drivers, and we believe we can take prudent return in these asset classes to generate that necessary return. So not to put a too fine a point, but because what we're using here are just assumptions generated based on the best information possible or available at this point. But the punchline here is, as Paul mentioned, we're not actually recommending large changes to the asset allocation at this point. The decisions you made in 2022 have set a good course for the plan, especially in light of your risk tolerance and the objectives that you have that incorporate contribution rate volatility. So the recommendation you'll see is a modest adjustment to the current policy allocation. So with that, let's go to page 55. So the liability statistics that you see in this study is based on the data provided by GRS, that is as of June 30, 2024. So this shows the plan characteristics for the whole system, the 401A pension plan and the 401H supplemental health plan. But as you're well aware, 401A plan is the main driver of the asset and liability of the system. 96% of assets and 98% of liabilities. as you saw in the oversight report, the portfolio has been able to generate returns that are higher than your assumed rate of return of 7% for most periods. So on an actuarial smooth basis, the plan has those returns above 7% still to be recognized. So that should be beneficial from the asset side, contributing to the plan health. But on the other hand, the increases in the payroll, the system's experience will be a bit of a headwind on the liability side.
I have a question before you leave that slide. On the last point there, can you explain that, or somebody explain that to me?
Sure. So in actuarially, the assumption going forward is, okay, there's an assumption for payroll growth. It's usually around 3%, somewhere around inflation plus merit. So 2.5 plus 50 basis points of merit increases. Post-COVID, Arizona is not unique in this situation where there's been rounds of hiring and salary increases above that 3%. So actuarially on your liability, your pension benefits are tied to your salary. So if my salary goes up above 10%, okay, I've got to pay. The system has to pay for that. We didn't expect that. That's a loss that has to be paid for in the future.
Yeah, add to that.
Yes, please.
This is a really important point, I think, and super more important when you go on the actuarial side than the investment side. But there's really two axes that you have to think about with this bullet point. And one is there's two causalities to increase payroll. One is more staff, and one is staff increases in salary. Those are not the same, and they have different impacts on liabilities. So you can have payroll growth go up, either because you have more employees, or because the employees you have greater than expected raises.
That's what I was trying to figure out, which of these it was, or if the combination.
Is that correct?
Yeah, I mean, I would ask Paul Wood at a GRS about this, but from the valuation report, it's a combination of pay increase plus payroll, overall headcount growth.
That's the first thing, really important. So if you only manage, so there's two hats to wear if you're a manager. Plus, you want staff to get nice raises. But if you're managing a liability set, you actually just would prefer to have more staff and not raise. And the reason is that if a current staff member gets raised, their pension expectation has increased. It's how to hire a new staff member, but new staff member won't get any pension or liability until they work sometime and then they pay the normal cost plus unfunded liability payments, if you will. So they actually come in and they are paying towards the current unfunded liability status. So you've got two things to think about when you've got more employees causing payroll. You've got the current employees, the pay use expectation. And then the second thing is two ways to look at that liability. One is the aggregate dollars. I suggest that's the right way to look at it. Our liabilities aggregate going up. The other way to look at it is the liability as a percentage of payroll going up. It's nice to see the liability as a percentage of payroll going down. We have cases where, and this is we're in that situation now, that simply by having more employees and more greater payroll growth, the liabilities is a percentage of payroll is actually limited or falling, when really liability went up. So it's a really important thing to absolute, which is size of liabilities and relative size liabilities divided by aggregate payroll. This is really fundamentally important. We're talking about liability.
Hey, Jay, real quick, this is Kevin. I'm having a really hard time hearing Paul. I don't know if you're able to hear him. Maybe get a little closer to the mic. Thank you.
Thank you. I just realized I had my mic off during that last commentary. Jay, were you able to hear me?
You're on mute.
And Jay, now you're on mute.
Yeah, I could hear you because I turned my volume way up, but I sent a comment in the webinar chat. I didn't want to interrupt you. That I thought your mic was muted. So
yeah. Okay. Thank you. And thank you, Kevin. I did have my mic off during that comment. Thank you.
Okay, great. So if we turn to the next page, this Great. This is a snapshot of your current system profile in terms of funded ratio and policy allocation. So as of June 30, 2024, the system's funded ratio was 74% at a 7% discount rate, and the fiscal year 2025 contribution rate was 24.2. If we look at the current policy portfolio and taking what Paul described in terms of NEPC's forward-looking asset class assumptions, performance assumptions, and then also ASRS's projected assumptions, you can see the return and asset volatility data in that table. Your current allocation or policy target allocation is 44% target in global public equity, 10% in private equity, 23% in credit, 6% in interest rate sensitive, and 17% in private real estate. So based on those targets, not your actual, but those targets, using NEPC's beta assumptions, the 10-year annualized median return expectation over that 10-year forward-looking period is 7.5%. And over a 30-year period, that expected return is 8.6%. And the expected standard deviation of those returns or volatility terms is 10.6%. So the ASRS projected return, as Paul explained, that reflects the staff assumptions incorporated into the beta assumptions of NEPC. Those returns are a little higher for the 10-year period. The annualized return expectation there is 8.2%. And then the 30-year is very similar at 8.5%, and the volatility is slightly lower at 10.4%. We're going to go dig deeper into these numbers as well as the alternative portfolios to consider.
Rose, just one quick question before you, at a high level, before you dig more deeply. Can you explain just why the ARS projections over a 10-year period exceed the NEPC projections, but over a 30-year period, they slightly fall short of the NEPC projections?
Yeah, it'll be easier to show you where the differences are in the
That's
later
fine.
on in the slide.
As long as you're getting to it later, that's fine. That's no problem. Sorry, I didn't mean to take you out of your flow.
No, that's okay. Okay, so if we move to page 57, I just want to expand on the assumptions and the methodology here. So as I noted in the previous slide, we generate these capital markets assumptions. Just as a background, how we generate those assumptions is important because it is obviously incorporated into the ASRS projected assumptions as well. So we generate forward-looking capital markets assumptions on over 70 different asset classes in terms of their return and volatility. We generate these assumptions for 10 and 30 years, and the 10-year return assumptions take into account current market valuations. So we use a methodology called a building blocks approach. Basically, it's a framework where we identify key inputs or drivers of asset class performance, and then we combine that to build up to in our model to estimate the investment return on a forward-looking basis. One of those building block is a valuation. So if current valuations in the market is higher versus historical trend, that would take away from our forward-looking return assumptions. And if the current valuations are lower than historical trend, that would be additive to forward-looking returns, assuming that you haven't pulled those returns forward already. So for example, I'll just briefly mention the return drivers that go into this building block approach for public equities. We have a yield component, including dividend yield, and then actual growth of the company earnings in real terms. And then we layer on the inflation impact on that, so nominal growth in terms of earnings, and then what I mentioned in terms of valuation versus long-term trend. And then for private equity, we layer on there an illiquidity premium for obviously locking up your money for longer term. For the 30-year assumptions, those are really more actuarial purposes. That is sort of more closer to the terminal value or the risk premium. And Robin, do you want to add to that in terms of our terminal
Sure.
value
So
assumption?
Rose is trying to describe, the difference between the 10 and 30. The 10, there's a deterministic path to those components of return, earnings growth, yield, valuation. Where you look longer term, we're somewhat naive in that, it's hard to predict 30 years from now. 10 years, it's a little easier, but we attempt to project 10 years on that deterministic path. So looking out farther to 30 years, we fall back more on that risk premium type model. So you're molding that 10-year path to this 30-year long-term kind of risk premium type model where it's, think cash plus 6-7%, that type of return expectation over those long periods, especially on the equity side. Fixed income, it's still more of a mechanical type asset class. Yield, your yield is essentially what you're going to earn, plus or minus credit defaults and things like that. But equity is really where that risk premium model takes some impact.
So with that, so I think I heard you say that for the 10-year model, it's more deterministic in nature, the cause and effect, but without really considering the effect of randomness. And so is the 30-year model more of a stochastic model? Those 2 points are kind of bandied about through the presentation, and I always have a hard time kind of reconciling the two. Can you elaborate on that one for me a little bit?
Not quite. So here's how I would describe it. On the 10-year deterministic path, your starting point is really going to matter. So if valuations are really high at the start of, at 12/31/24, which they were, on S&P, it was 25 times. That's going to have a big impact on that 10-year path of returns. Over 30 years, that's only 1/3 of a longer term horizon. So your starting value, especially valuations, which is the most kind of volatile, less fundamental component of return, earnings growth, inflation, those track, they're pretty stable. It's the valuation figure that is all really sentiment based. There's some fundamentals, but it's really a lot of sentiment backed in that. And it's really hard to get right. So that's why, and it has we have charts on this, but it's a big impact on that 10-year return forecast relative to the 30. So the stochastic thing is kind of a separate type of analysis.
Okay. All right. Thank you.
Slide 28.
Paul, your mic's off again.
Yeah, if we can go to slide 28. It would be page 81 in this presentation. And that's NEPC.
The next page.
Okay, and go for, let's see. For global equity, if you look at the top 5.9% with ASRS, the next slide, go down one more slide. So look at that 5.9, that's a big one. And we've got 7.11. And I think the primary driver there, and I'm going to look at NEPC, is your perspective on valuation. So you've incorporated, when you built up your number, dividends, earnings growth, and also valuations. When you did your 30-year number, what I would expect is you probably did more of a spread premium analysis, where you looked at to make sure that a stock returned more than a bond, for instance, right?
Right.
And that's where ASRS was different here. If you go back now to NEPC, one page. So staff would back one page. Staff would look at this and say, wait a minute, global equities are making 5.9% on average over 10 years. And what do we got? Let's just see here. Credit. Okay, credit is 8.73. So credit usually is a less risky part of the capital stack than equity. You would think there would be a positive premium between equity and credit, not flipped. So if you incorporate sort of a rational analysis, the way that NEPC does it, you can justify those numbers. But then if you flip it and you say, no, we're not going to do that analysis. We think the markets are efficient. So go back to market efficiency. We think markets are efficient. Therefore, you need an equity premium over a fixed income return in order to have a rational capital market. Then you get the next page, which is ASRS assumptions. That I think explains most of the difference. Is that correct, Rose or Robert?
Yeah, so just one comment here, and since we're getting into this, I think it's important to sort of make sure everybody's on the same page here. I'll talk about two things. One, we're purely here talking about, when we say NEPC beta assumptions, we're purely talking about what the market itself will return if you invested passively across all of these asset classes fully. So all the investable universe within these different asset classes. That's where our assumptions are anchored in terms of, overall market passively managed. Obviously, your portfolio is not all passively managed. We expect active returns, not only just from, hiring active managers externally, but also through your portfolio construction that is constructed to meet your goals, as well as your tactical views. So as Paul mentioned, the difference between our assumptions in terms of market return versus ASR's returns takes into account ASR's house views. And then it also takes into account what your specific portfolios, the assets that are in your portfolio, not the entire general asset class, but whatever's in your portfolio is likely to generate. The other, the difference between global equity and credit here, I just want to clarify that credit assumes also mostly private markets credit. So there's some illiquidity premium built into there as well. It doesn't change the fact that our equity assumptions are very low given our valuation. So if you look at private equity assumption, it's still lower than private credit assumptions, 8.65 versus 8.73. And that's being driven from our low public markets equity return assumptions because of the high valuations.
I've got one request for when we have the actual board meeting. This slide, I guess it's 81 of 199, or slide 28, which is the NEPC beta return assumptions. And then the next page, which is the ASRS assumptions. If we could have a chart that shows that top right corner of the 30-year, the 10-year and 30-year returns, compare and contrast NEPC and ASRS, I think that'd be helpful for everybody. It's kind of what you were doing, Paul, where you were flipping back and forth between the slides, and I did the same thing when I was reviewing the materials. I think that'd be helpful for people just so that we can understand the distinction without having to go back and forth.
Certainly.
Thank you. And I think you do that in a later slide for a different dimension, for a different variable, but that would just be helpful on the return assumptions as people try to digest that in the broader group. Thanks.
Sounds good. Okay, so just one last word on assumptions and methodology. If we can go back to page 58, and I'll turn it over to Rob to go through the liability side and then the projections.
Sorry, I was a little mixed up there.
Sorry, before you do that, because I'm trying to use Govinda to bring up my questions and not sure where you're going. So I want to go back to slide, I think it's 43. I have a question. And
Which slide?
43 of 58.
Of our.
I don't know what, I don't have what the other number is. I'm just bringing up the 43 of 58. It's the geometric expected return, NEPC
96.
10-year return forecasts. There's one equity and then the next page is fixed.
Would this be it?
Yes. Yes. So this is a kind of a generic question and maybe not the time to ask the question, but it popped up in my mind as I was looking at this. Is there a point? So, well, first of all, explain geometric expected return and you show 10-year forecast, but you're showing, I'm looking at, the one I'm looking at right now is the top one, US large cap equity. 12/31/24, 12/31/23 delta, but you're also talking 10 years. How? I'm confused about that.
I'm
That's not my
sorry.
question yet, but I'm confused about that.
Yeah, so these are 10-year forward-looking forecasts, but as I mentioned, we update these on a regular basis. So at the end of 2023, our forward-looking 10-year assumption for US large cap equity was 4.4.
Gotcha.
And at the end of last year, it's 5.6.
Okay, that makes perfect sense. Okay, so now the question, is there a point where I'm looking at large cap equity, 5.6%, and I'm looking at fixed on the next page at, say, corporates AA, so their investment grade. Is there a point where, and I know there's lots of fluctuations and everything, but if you're looking at a 10-year return, less risk with the fixed, which doesn't make any sense to me. But as I'm looking, it's pretty stark. So I'm not even asking my question well. Is there a point where you consider more fixed, less equity, or can you kind of figure out what I'm asking?
I think if I can try and summarize your question or understand your question, fixed income is supposed to be more safe than typically lower because it's a safer investment or less volatile investment than equity. And that's, I think, what Paul was getting at. So are we taking into account these risk return trade-offs when we are looking at asset allocation and what we think the portfolio is expected to earn? The short answer is yes. Obviously, we are taking these numbers and putting them into your allocations and see what the portfolio will generate in terms of expected return. Your point about the expected return on fixed income or high quality fixed income, why is it so high when equity returns are expected to be so low, is precisely the discussion that we were having about how our model takes into account in terms of our approach of taking valuations, or at the end of 2024 valuations, which was quite high, and putting that into the model. This is what the model is saying. The valuations are so high, you've already enjoyed a bulk of the returns that you're expected to get in the future, because those future earnings have been pulled forward. So you can expect less according to the model going forward. I want to emphasize that we have this model so that we have a systematic framework to put these return drivers into the model. But it is a model. It is not we take this blindly and say that's exactly what it's going to earn. So this is why we're incorporating one, client portfolio specific return expectations into the study, as well as the staff house views on the specific asset classes that they'll be investing in. This is a very difficult time in capital markets valuations to justify what the model is producing, because the equity valuations are unprecedented. So that's where the disconnected, and that is a very, very fair question.
I've got a question back on slide 43, the previous slide, so 96 of 199. I'm having a hard time reconciling. So I saw you, I remember going through and seeing your S&P chart from 23 to 25 and the significant up and to the right. And in 12th, and what you also just said was that you've taken a deterministic model in your 10-year forecast, which layers into kind of current valuation. So from a lower valuation point in 23 to a significantly higher valuation point at the end of 24, you've still got you've got 5.6 versus 4.4%, you know, on your large cap number. I get that there's growth assumptions there, there's inflation assumptions, but can you explain that a little bit to me, just how you went from 4.4 to 5.6?
Yeah, I'll have Rob chime in here, but again, this is, we weren't going to go into this in depth, but given your astute questions here, we will have to. There has been adjustments made to the model to reflect a very different valuation environment that we're, and also subset of the equity market that has driven the performance or the valuation of the equity market performance. So we've made adjustments or enhancements to our model. I'll let Rob go through the details of that.
Yeah, so we have this in our capital markets materials that we provide, you know, every quarter that we update models. And at the end of the year, every quarter we, you know, do a review of the models, but at the end of the year, calendar year, we take a deeper dive, try to pick one aspect of one model where just improve on, you know, is the model reflecting our views or vice versa? Is it not? And I think the US equity model, you know, we looked last year, an expectation of 4.4 is low. And 24 was a great year for equities. They're up 25%. So just doing just being an astute person, if the return was 4.4, we just had a 25% year, forward expectations should probably come down. And if we made no changes, they would have come down, think, you know, under 4%. And we look at US equity and our internal view of, you know, do we really think US stocks, large cap stocks, are going to return 3.5% over the next 10 years? And none of us believe that. So we took a hard deep dive on our model, specifically US large cap, and updated, you know, two main components. It's the ones we've talked about. It's earnings growth, specifically margins. You know, what is the sustainability of current profit margins of, you know, the top 500 companies in the US? The top 7, the Mag 7, are the highlights of that. You know, they're almost utilities in nature. Think, you know, Microsoft as an enterprise software company, Apple is a consumer provider of technology, and all the other companies have similar things like that, where they're just kind of embedded in the economy. So we think those margins are more sustainable than we thought previously. So what does that mean? Well, we just adjust margins higher for longer. The other component is that valuation piece. You know, if you took a long-term history of the S&P 500, you know, 100-year and you took an average of profit or of PE ratios, price to earnings ratios, it'd tell you the long-term average is 15. Today, it's around 25. Now the index, the companies within that are fundamentally different. They're tech-based, they're growth-oriented versus, you know, 50 years ago, steel companies, oil companies, things like that. So the index has fundamentally changed. It took us some time to incorporate those changes and realize, well, are they sustainable or are they not? I think we came to a conclusion that they are for the most part. And that's why we adjusted those higher. And that's why the return went from 4.4 to 5.6, even despite a great year for stocks.
What about the yield?
And the third one is a smaller thing, but if you look at, and this is something unique to US large cap stocks, is they pay lower dividends, but they return capital to shareholders in a different way, and that's through buybacks. That's another thing that we took a hard deep dive on. What's the sustainability of buybacks as in terms of you know, return of capital to investors? And to all the same points I made earlier, you know, we do think it's sustainable given the hold they have on their place in the economy. As long as they're making margins, they can return capital to shareholders in terms of buybacks, less so than dividends. So adding those three components, higher margins, higher PE ratio, and a buyback assumption, then that's how we come up with that increase in return, despite a great year for stocks.
That's super helpful. So Rob, if you went back to 2023 and applied your new model, instead of it being 4.4%, it would have been something like 6.5%, because you would have baked the growth that we would move from 6.5% to 5.6% in 24 because of the 25% growth on the valuation side effectively. Is that a fair assessment?
That's a good ballpark number, yeah.
Okay, thanks.
And Chair Pacunis, if I may add one more comment?
Sure.
And that is, Trustee Landis, the way you thought about it and asked the question about does it make sense to maybe shift asset allocation more, say, fixed income because of those expectations? That's precisely why ASRS and NEPC had this discussion and debate prior to this meeting, because it is logical. If you took away the row headings and you didn't know it was talking about US stocks and didn't know, you would look at it and say, well, wait a minute. You investing in something with a higher volatility and a lower rate of return, now's the time to shift the other way. So from our perspective, the expectation logically has to be that you have a greater expectation for a higher rate of return on the equity side than on the fixed side. And that shows through with the staff expectations. I like the way NEPC has built their model. It's a very rational model. But if you were at a university course, your question would be exactly right. You would say, well, wait a minute, and you build an efficient frontier and populated the efficient frontier with all the different things, you would come to the same conclusion. So you're thinking of it the right way, if I may.
All right, thank you.
Okay, maybe we can go to the projections section. Do you want to make a couple comments on the liability assumptions?
Sure. So, this is a.
Sorry, 58.
Paul mentioned a lot of this already, but this is almost a group effort with staff and GRS. Paul Wood, your actuary at GRS, we've had conversations over email to get data from them and kind of hammer out some details, but I think this is the wrong page.
58, did I say?
There we go. Page 111 of
No, this is good.
199. Oh,
Perfect. So, we're using the most recent information and data calculated by GRS, which is as of June 30 of 24, when a report was dated. Gathering information from GRS and staff, and just some assumptions we've made are all consistent with that report, payroll growth at 3%, and other things, especially with the liabilities. Those are what they are. The thing that we come in and the value we add in this analysis is the ability to model different allocations, their impact on volatility, on return, and ultimately what Paul mentioned earlier, contributions and funded ratio volatility and outcomes. So that's where we come in, and the portfolio returns you see in the projections are our expectations, not let's say GRS's long-term investment return assumption of 7%. Next slide, like 2 forward. So this is
On page 60.
So we'll see, these are, we'll call them deterministic outcomes. And this is assuming the NEPC beta return assumption. So over 10 years, we're expecting 7.5% per year. And this is funded ratio, so assets divided by liabilities. Today, it's 74%. The path here doesn't really matter. It's going to be unknown. I would focus on the endpoint. So today, 74, 10 years from now, hopefully 88%. 14% gain in funded status is in line with the 7.5% return assumption. There's going to be uncertainty and variability, but the endpoint is what you should focus on. In the next slide, okay, what are contributions? I guess this is funded ratio for the system. I should have said earlier that slide is the system. So the health plus the pension. Here are those individually. So The pension's increasing the 14%, and the health is slowly drawing down. But we'll see on later slides what the path forward is for that health plan. The next slide.
Hold on, Rob, what's the distinction between the market value and just the, so the, you know, the first and second values for the 401A and 401H?
Great question. So the market value line is, it incorporates the entire volatility return. So if returns are 20%, that's fully reflected in your funded ratio. To what Paul said, there's a 10-year smoothing, and that's what that other line is, the non-market value line. So you'll see the smooth, we'll call it the smooth line. That's consistently below the market value line because you're out earning your assumption of 7%. So your market line is incorporating that full 7.5% return, but the actuarial is kind of, you know, phasing that in through time. So you never really get back to what the market value. So you're always, the market line is always, you know, ahead of your smooth value.
Got it. Thank you.
The next slide. Fine. Okay. Now we're in the contributions. So over the next 10 years, today, the contribution rate's 24.2, and that has a 50% share between employers and participants, your active employees. This is another sort of layer of smoothing. So typically we'll see less of a contribution share between, you know, let's say employers and employees. Usually it's employees pay somewhere 8 to 10% of salary, and that's always what they'll pay. Here, employers and active employees share in the cost and volatility of contributions. They're already smooth due to asset smoothing and amortization of gains and losses. But here you have employers and employees sharing in that volatility, which is a kind of another layer from either employers and employees' perspective of contribution rate volatility. And over time, we'd expect that to come down from 24.2 to 21.8 over the next 10 years. The next slide, another important one, is what's the cash flow situation? So money coming in, contributions, employer, employees, and benefit payments going out, plus a small sliver of admin expense, which you can barely see in terms of dollars here. But, you know, today it's about negative 2.3%, you know, on an expectation basis for FY25. And we'd expect that to mediate down to about 3.3% of assets. Now, you know, that might look bad. Hey, we're paying -% of assets, but that's typical, right? You're a mature pension plan, you have to pay benefits. And if you look across the landscape of public funds, it ranges anywhere from -2% to -4%. So you're right in the range of your peers. And you know,
Rob, just quick question on this. So when we talk about, say, the NAV for the fund is up, you know, up, say, to 56 billion from 54 billion, that reflects the net cash flow out as a detraction from that value, and then the incremental return on the book to drive that value, right? So
Yep.
just I'm contextualizing that.
So your assets are growing through this
Yep.
period.
Got it. But so if you had, just in a simple model, if we had 7% asset growth and 2% net payments, you're growing net 5, right?
Yes.
Okay,
That's
got
a
it.
good way to think about it. Yes.
Okay, got it. Thank you.
So that's over 10 years. And, you know, we talked about this earlier. What's the difference between 10 and 30? The 30 years more long-term, and it gets back to, wait, equities should return more than bonds. So longer-term, higher expectations for returns, mostly because, you know, the equities fall back on a more risk premium type model, which is the next slide. So this is funded ratio over 30 years, long-term. Today, 74%. Long-term, 30 years from now, over 120% funded. And now, the ideal way to fund a plan is you get to 100% and you stay there forever. But here we're out earning our expected return of 7%. We're assuming 8.6. So that consistent 1.6 above the 7 gets you to this overfunded position, hopefully, theoretically in the future. This is assuming no changes are made. The only change is the return of 8.6, right? Things will probably change over 30 years, right? The benefits change, contributions change, all these other things change.
And your allocations can change over this time. This is just looking at current policy allocation and the assumed return of 8.6% annualized over the 30-year period.
So I've got a question here, and it's funny, I talked to Mike and said, I don't have a bunch of questions to talk about before, and shame on me, but if we took this model, so ASRS has overperformed over a 20-year period, right? And if we took the same model construct and went back 20 years, it probably would have told us then, if we knew our overperformance, that we would have been better than 75% funded today, right? What's the flaw? Like, it just doesn't feel reasonable to me that 130, I get it's actuarially sound, but from the 131%, years out just feels flawed to me. And if we applied the same model to 20 years ago and had overperformance, how is it that we're at 77% now?
I mean, this is a great question. And this is why I caveated that if everything stays the same.
Yeah.
And falls in line with expectations. A big one, why the funded ratio hasn't grown recently, the last 10 years, there's been investment return, you call it reform, a lowering of from 8% to 7%. That's a headwind to funded status, even if you're outperforming your expected return. Another one is the actuarial assumptions. Think mortality, which probably has the biggest impact. 20 years ago, it's gotten much more sophisticated. People live longer. I mean, it's a great thing, but it's a cost to the plan that was unexpected previously. All those things, economic assumptions, all those things kind of go into that.
Well, like take your mortality assumption, for example, though, right? It's logical that 30 years ago, we could have expected that mortality rates, would improve. Are we expecting in your actuarial model that 30 or 40 years from now, mortality rates improve as well? Or is that just based on, kind of a default, a static assumption?
So there's static, and then there are improvement tables that actuaries, apply to that. So there's a 1% today, 20, and the next generation is probably going to be a less chance because there's, society improve, healthcare improves. I believe all those assumptions are embedded in GRS assumptions. But I think it's a more recent, maybe in the last 10, 15 years, type of demographic assumption and application, where 20 years ago, they weren't doing that type of thing. So it's an improvement to the assumptions. It just has an added cost, and it's been a headwind to funded status.
Yeah, and it feels like the more relevant time period is looking over 10 years, because the same way we know as you get out further past 10, there's more variables to try to account for. But is part of the story here that we're rapidly increasing from 74, 77 to 98, 92, 10 years out? Is that a function of some of the historical outperformance that Paul talked about, that is being kind of spread into the future years? Is that?
I would call that more of a tailwind. The driver of, the steeper line in the first 10 years is the contribution, the funding policy.
Okay.
There's a policy in the books to, get to 100% funded in around 15 years. And that's where you see you're reaching that target within that, roughly in that time period. So really, investments are a piece to getting to good outcomes and funded ratios. When you're underfunded, like 74%, contributions are really the bigger factor getting to where you need to be.
That's helpful. Thank you.
And Chair Pekunis, may I add a couple comments?
Absolutely.
I think your question is really spot on, as far as if you cut and paste this model 20 years ago, would things have turned out significantly different? And given that we've had outperformance over that period, why not? And there's four fundamental reasons. We've already discussed some, but I'm going to go through them. Number one, almost continuously, year after year after year, benefits were increased and not pre-funded. So every single legislative session, certainly up until approximately 2004, benefits were increased and not pre-funded. You had an increase in the multiplier, you had an increase in graded multiplier, you had increased in refunds, you had increase in health insurance supplements. There's all these increases not pre-funded. So the assumption when you have sort of an actuarial balance sheet is you're above 100%, below 100%, above, below. But what happened was every time we had a funded status of above 100%, liabilities were increased, not pre-funded, and that would push you down. So that's number one, increased liabilities that were not pre-funded. Number two, don't forget our assets were essentially discounted or present valued at 8%. Now they're present valued at 7%. So we went through a step function where the liabilities continued to increase from set at an 8% discount rate, 7.75, 7.5, 7. So that everything else is held harmless. Nothing happened except you just changed an assumption and your liabilities went up 20%.
Yeah.
So the next one, there used to be a state law that demanded or required the Arizona State Retirement System to use an actuarial valuation method called PUC, which stands for projected unit credit. And that was a less conservative methodology. So we worked with the legislature to ask them if they would authorize the Arizona State Retirement System to determine the actuarial methodology. And we've migrated from PUC, or projected unit credit, to EAN, which is entry age normal. So that was a more conservative methodology, once again, increasing projected liabilities as measured. And then finally, with respect to the mortality table, the mortalities increases were typically incorporated, but on a step function basis. So you didn't smooth in, if you will, or recognize mortality changes each year. You would do nothing for approximately 4 years, and then you'd say, hey, we had some liability losses or actuarial losses on mortality, and there'd be a step function increase. So all of these, I think, are really important. We've worked with the legislature for some time, making sure that benefits, if they go through, are pre-funded. The discount rate, we're at 7% now. As you see, the projections, both with NEPC and ASRS staff, those projections are not to drive the 7% down. Our expectations are for a higher than 7%. We now use EAN. So all of those reasons in aggregate, plus some much smaller reasons, are why if you cut and paste this model 20 years ago, it would have still been problematic.
Got it. That's very helpful, Paul. Thank you. And by the way, I want to add that whether it's automated or someone's physically moving the camera, the virtual meetings are great now because I can see who's talking. So that's a big improvement over the last one. So thank you for everything, guys.
Great, I'll hop back in here. So again, we're on 30-year basis here. So this is the system level. The next slide is the individual level. And I preface this, what happens to that healthcare plan is, think about that. This is a discussion I had with Paul Wood at GRS. It's a flat subsidy type plan, a flat dollar. So through time, payroll increases, through inflation, all these absolute dollars are increasing, but the benefit, at least today, we're assuming stays level. And that's why through time, that actually kind of just explodes in funded status to over 2 times, 200%, with actually no contributions coming in. So that plan, as it sits today, and assuming that long-term return of 8.6 is self-sustainable, given current assumptions and all the things we talked about. That could change, but today it's on a good trajectory of what you see. The next slide is contributions. Through time, as you get to 100%, contributions come down because you're not paying for that unfundedness, right? You reach 100%, and the only cost theoretically is accrual cost, right? Active employees work 1 more year. That's as a cost that we call normal cost. And that's that 14% that I think Paul mentioned. Well, you see, we actually go below that because we get to an overfunded position. You have a surplus. That surplus is able to decrease that contribution rate below that stabilized cost of 14%. So that's why we drop not only below to 14%, but well below it ultimately zero theoretically. The next slide is net cash flow. So there's the good and the bad, right? So if you get to 100% funded, we don't have to contribute as much money, as much dollars. However, we're still paying out benefits that are kind of always increasing. And that's where you get to this point of, okay, negative cash flow goes from 2 to -4 to 5%. And that's where you start having to manage private programs more tentatively with your net cash flow. It's because it's in definitely a worse position, but that's a long way from now. And still we're not close to that, but it's something to be informed about. And the next, few slides, I think we can skip these in the interest of time, but this is the same slides. It's just the only thing that's different is the ASRS projected returns, which, as we mentioned, the equity return is assumed to be higher. The portfolio return is higher. What does that mean? It's better outcomes, higher funded status over 10 and 30 years. Oh, we have one more section. So 78. And I think, Jay, you mentioned stochastic. So this is where we can get into that. And I mentioned deterministic, stochastic. They mean two different things. Deterministic, you say, we think returns are going to be 7.5%. And that's what you get every single year in the projection. The stochastic means just random, right? We don't know what returns are going to be every single year going into the future. We make an assumption of the average rate of return over a given time horizon. And that, however, has a range of outcomes, right? Plus or minus a standard deviation within 66% likelihood. This tries to quantify the variability, the uncertainty in investment returns, and filters those through the asset liability outcome. So there's variability in investment returns. That means there's going to be variability in funded ratio outcomes. And this quantifies that in percentiles based on your current policy. So the 30-year returns based on ASRS projections, mean return and mean volatility assumptions. So to pick one data point out, if you're really optimistic on market returns, let's say, if you look at 2035, the top of that dark green bar is above 100%. So you could say, hey, within 10 years, and I'm really optimistic on markets, we could be 100% funded in 10 years. Like that's within the range of outcomes, not our expectation, but given uncertainty, it's definitely a possibility.
What are the bands? So it is 5th to 25th. Is that percentile relative to the peer set, or what is that? What do the bands represent?
Sure. So we run 2,000 simulations. So think what 2,000 lines of funded status are. These are just the percentiles of all outcomes. So
okay, so of your, I got it. That makes sense. All right.
And the following slide is just the same thing, but in terms of contribution rates and inverted, right? So an optimistic outcome is a lower contribution rate. If you think optimistically, you get to 100% by 2035, the contribution rate goes to around 14%, that stabilized rate that we talked about earlier. Now I'll pass it back to Rose.
So unless there are any questions on the projected contribution rate and funded ratio, we want to go into the asset side again in terms of alternative portfolios based on NEPC assumptions and ultimately ASRS projected returns. So if we go to page 81. So in addition to your current policy portfolio, which is all the way to the left, Steph and NEPC modeled a few alternative allocation mixes. And then we also included here allocations based on the survey results of National Association of Senior Investment Officers, or NASIO. So this is just so that you have a context of what other plan allocations look like. But keep in mind that obviously every fund has different objectives and different liabilities and different risk tolerances. So that's just for your context. What you'll notice here is that most of these alternative mixes are just modest changes from the current policy, with the exception of alternative mix 2. I'll talk more about that in the next slide. I'm not actually going to spend a ton of time here because the next page shows the same set of alternative mixes with ASRS projected returns. But I will note here, look at the outcome, and this is just based on our beta assumptions, the bottom part of this table. The outcome for the 10-year expected return, the 30-year expected return, and then the standard deviation. Across the board, it's very, very similar. Your current policy target expected return is 7.5%. All the alternative mixes are pretty much similar. And then the standard deviation is all very similar, with the exception of alternative mix 2, which is more conservative. Again, I'll talk more about that on the next slide. So this is the same mixes, but you see on the right-hand side, the boxes highlighted in orange are where the return assumptions and volatility assumptions deviate from NEPC beta assumptions. So particularly on the 10-year side, the return assumptions are higher, particularly for global public equity and private equity. And volatility assumptions are also lower than the NEPC standard set assumptions of volatilities. So if you look across the output table again, the 10-year expected returns are higher across the board, given the higher equity and credit assumptions. The alternative mix 1, where you see the different allocation than the other mixes. So this particular alternative to consider, or for your information here, takes down the equity risk meaningfully. So you currently have a total of 54%, 44 in public and 10 in private, taking that down to 35, and then really putting in that that allocation into other asset classes that are expected to perform better in a risk-off environment. So if, for example, equities have a big drawdown at some point, these asset classes that are added, treasury inflation protected securities, infrastructure, gold, long volatility or tail risk hedging strategies, and trend following. So allocations to these strategies are expected to be diversifying in those scenarios. So you see that the return expectation for alternative mix 1 for a 10-year expected period is lower, so 7.8% versus the other mixes. But then the standard deviation also comes down to 8.2%. So this is really a question of thinking about, are you comfortable with the volatility that is potentially going to be experienced through these allocations of 10.4% standard deviation, or is the board risk appetite lower, in which case the standard deviation in this conservative mix is 8.2%. Obviously, keeping in mind lower return, lower volatility means, in the future, potentially lower funded ratio and potentially a higher contribution rate. But we wanted to put these mixes forward for you to consider. Again, largely small changes. The NEPC mix is quite similar to the staff recommended mix, with the exception of a small decrease in private equity and increase in interest rate sensitive. This is based on our beta assumptions, given the lower expected return on the equity side. And as you mentioned, the very small difference between fixed income or safety assets versus equity, the risk-adjusted return potential is lower based on our assumptions. So when we move that allocation to interest rate sensitive, increasing them from 6 to 10%, we get a similar type of return expectation. Mike, do you want to make any comments here?
Sure. I'll just go into a little background on the highlighted in yellow projected return assumptions. This is where we end up differing from NEPC. Just a little preamble. So the building block methodology that NEPC uses is similar to other providers in the space, right? And I'll get to the other providers in the space because it informs our view. Once a building block baseline has been established, and these are my own words, not necessarily NEPC's words, they might use the building block as treasuries or maybe a 10-year forward rate. And they end up building other historical risk premiums on top of that for all the other asset classes, just as Rose indicated, yield, growth, inflation. So though that ends up providing, I'd say 95% of kind of the return assumptions. The last step ends up being kind of a qualitative component. So you heard Rob and Rose talk about looking at their methodology, maybe changing a little bit. So that was kind of a qualitative change to make. You'll find this consistent across all other competitors in the space. I've had the opportunity of working with several general consultants across my career. So has Paul. They don't tend to differ remarkably, but where they do differ on these kind of qualitative assessments, they end up making decisions on how to tweak their models. And so we as staff ended up looking, and this is a common practice across pension plans. Their general consultant will say something in asset allocation policy, but then we want to see what everyone else is doing as well, right? Just to make sure there's a level of sanity check here. So in looking at other highly well-regarded consultants, we also end up looking at other asset managers because they have skin in the game as well. So you end up looking at a Blackstone, a BlackRock, a PIMCO, a JP Morgan Equity to see what their capital market assumptions are. So that goes into a certain extent into forming our own qualitative assessment, or what Paul called their house views, right? NEPCs has their house views, all these other shops have their house views, we have our house views. NEPC has, in my short time working with them, has generally trended to be a little more conservative and a little lower, which is totally fine. I mean, they apply that capital market assumption perspective across all the clients, and it's great. We just had a different house view, and that was to a certain extent informed by kind of what's going out in the marketplace. The other component ends up being the ASRS alpha. So we've been managing assets internally for a long time. In the case of public equity, we have a certain built-in alpha component above and beyond the beta expectations. We're not managing 100% passive, it's enhanced passive. So that's the stuff that Cole and Vicente and Samar are doing internally, and the structures that we have with our public equity managers externally. So there's always some alpha component in there. So that ends up kind of being the building blocks that we're establishing. In the case of, I'll just start with credit. You'll see the 8.75% return. That's not significantly different than NEPC's. They're 8.73. So it's a 2 basis point difference. But the last strategic asset allocation policy, there was a difference between what NEPC thought and what we thought. This is informed really by the history and the returns that we've had with this asset class. It's been pretty consistent, high 8 returns. And so we just felt that was appropriate. There's a little bit difference in the volatility. NEPC suggests a 5.26% return. This is standard deviation returns. When we look at the credit history, so this is the 10-year standard deviation, it was 2.75, I believe. Does that sound right, Al? About 2.75 historically. We moderated up to 4.75, almost midpoint, because we thought, well, we're in a higher for longer environment, right? Interest rates are high. There could be a little additional stress in private credit due to impairments and potentially some write-offs. So we thought that was totally reasonable. So that's where we are with credit. With global equity, again, we had different views informed by kind of what others are in the space and our own views on what we think is going on in the market. The U.S. has been leading, it was mentioned, AI. U.S. continues to be a leader in that space that continues to drive returns. Even though we're in a higher for longer environment. The Fed increases have not really cut back on unemployment. That's something that seems to be happening with this administration. They're handling that. But in general, the market has been pretty receptive and the economy has been strong. So we expect that to continue. So that's why we end up having a 7.1% return on public equity. And then in private equity, we expect about a 3% premium above and beyond public equity. And we're confident with that because then there's a little bit of alpha expectation there. Over the last 5 or 6 years, we've been pretty successful in finding first and second quartile private equity GPs. And in addition, with the structures that we now have for investing in co-invest, that ends up being a higher return than our regular private equity structure. So we're pretty confident in the 10% return. So that kind of summarizes how we've gotten there and kind of our views. It's really the qualitative assessments and what we think is going to be going forward. If you go back and forth between the NEPC beta assumptions and the ASRS projections, you're not going to see much difference in the bottom line output. So it's just our view. It's what we think is appropriate based upon our history, what we see is out there, and those are our go forward expectations. So that concludes my comments. Thank you for letting me speak.
Mike, quick question on the private equity side.
Yes,
So
sir.
I understand the strategy and I like it is, you know, you find kind of best in class GPs and you're investing to some degree in some of their discretionary vehicles, but then you're going to layer on a nice slug of one-off kind of co-investments in where you have the discretion, right? Like, so you're kind of layering on these incremental investments outside of discretionary fund, but on a one-off basis. But does that shift? I guess my question for you in that regard is, as you're thinking about the volatility here of 12.09%, which is the NEPC kind of assumption for volatility, as you take, I guess, more of the discretion on internally to figure out which of those kind of sidecar co-investment opportunities you're doing in the private equity side, how do you quantify your ability to pick which ones of those you're investing in and the performance and the volatility relative to the managers that have their full discretion and are top quartile or top decile performers who are baking the cake, if you will, and you're just selecting individual ingredients when you do these sidecar co-investments? How do you guys think about that risk and the volatility relative to the return?
So great question. There's a lot of layers to that onion. So let me try and address it. So with our co-investment program, we have access not only to our GP co-investments, but also our strategic provider in this space. So we go through JP Morgan Private Equity Group. They've been doing co-invest for, I think, close to 20 years for their own funds. So we also have access to their co-invest. So that ends up providing a more diversified product, if you will. And we've got a 60-40 mix between that. So we want to make sure that our GPs, that we're utilizing our GPs co-invest conduit, but also take advantage of the diversification with the GPs. Lately, what's been going on in co-invest space is, I would say, going back a little bit, GPs would only take down what they thought was a good allocation for their particular fund. Nowadays, GPs are willing to take down a bigger swath of a privately held company, knowing that they have limited partners that are invested in co-invest. And why is that attractive? Why would a GP give away a co-invest with no fee and no carry, right? That's what the attractiveness of co-invest is. Well, they still maintain control. If they're able to give it the co-invest opportunity to their LPs, as a GP, they're still maintaining control of that company. So it's the control that's attractive to the GP. It's the co-invest, the no fee, no carry aspect that's attractive to us. So on a go-forward basis, we're looking at the returns. We're looking at returns that are still above public equity, which we think is appropriate, but we're also kind of baking in that alpha component. As far as the volatility, I would say what mitigates that ends up being the diversification in the co-invest opportunity. I mean, you're right, to a certain extent, it is almost doubling down, but there's a certain screening, there's a certain process that we go through I'm trying to think right now, we've got about 50, Mike? 50 investments in the ground in co-invest? 20 investments in the ground and they've looked at about 50. So there's a relatively high bar for us to be interested in. And I thought it was a little bit higher than that, but it's not, we're not taking everything that's co-invest. We're making decisions in that space, not to move forward with some of them.
Well,
So
I guess,
I know it doesn't address your question entirely on volatility, but
well, where I was going, Mike, I guess was, so let's say that we invest, we allocate to a top decile private equity fund manager, right? And I realize we have fees and promote that we pay, but we're betting on that fund manager's judgment and the mix of investments in that fund, right? And so we're basically paying fees and promote to get the benefit of that team's judgment and their track record and their history. Now, I understand the attractiveness of saying we're going to cherry pick co-investments and not pay fees and promote. I like that part of it for sure. But are we now trading the judgment of that top decile private equity GP for our internal view of which co-investments to make and not make? Right? Like you follow where that's what.
no, I do. I think I do know where you're going. So I would say the screening by the GP of that portfolio holding company is robust. They're just, it's a competitive environment, so they're having to take down more and then allow their LPs or hope that their LPs will be willing to take kind of the co-invest component to it. So I'd say the due diligence, the investment, the operational due diligence ends up being the same. It's just the nature of the industry that's changed. Now, I think your question has to be more with portfolio construction, right? So the GP will limit themselves to a certain amount of a particular port holding company in their fund structure.
Yeah.
And so that's kind of shifted to us as to what makes sense. But we end up looking at it holistically. So we have a platform called Aladdin eFront. We're able to see kind of what our allocations are, including co-invests, to see whether that aligns with what we believe to be the direction we're going.
Mike, if I
Yes,
can
sir.
add to that, I think the question might be focused on how do we have confidence that we can pick among an array of portfolio companies better than the GP allocating more money to that particular portfolio company?
Much better said than I could say it, Paul. That was my intent. Yes.
Okay. And I think the answer has to do with diligizing the portfolio company. And we've engaged someone, JP Morgan. Do you want to talk a little bit about the diligence process that JP will be utilizing and then the oversight of the staff, JP diligence?
How about if we leave that for Samer? I can give a decent overview, but we
Yeah,
can
no,
kind of
Samer's fine. He's
we can
online.
get into a little more detail. Samer, if you're able to speak to that, please.
Yes, I can, of course. Okay, do you see me?
Yes.
Okay. So you're absolutely right, Jay. So there's the first layer, which is the GP. GP usually, when they come to a co-invest, it's their jewel asset. But we have a layer, which is our JP partners, JP Morgan, private equity. Their due diligence is, I would say, multiple times the bar is much higher. So what is included in the portfolio on statistically basis is 32% of what we see. So, and sometimes we are way more diligent than the manager himself or themselves. So that's why we are choosing the best of the best. And to give you an example, so the program had been in the ground for almost 20 months. And with all the J curve and so on, the valuations are not yet, but we have an idea about the valuation. The portfolio is up north of 22% net after the JP Morgan fees. And the total commitment so far would be, for including this year, around $900 million. So we were able to achieve a growth of the program from 5% almost to 12, 13% for this year in just 20 months. And we expect that to ramp up to 30%, and that would be extremely meaningful. So the diligence, the underwriting, one day, if we can share a memo with you, the memo is 55 pages that goes into the expertise of JP, and we are involved on, I would say, weekly basis, but we have a long meeting on a monthly basis, and we go through it. And when there's an allocation that's higher than certain threshold, we have to approve it, including our committee.
So Samar, just so that I understand, like if I want to kind of pull on the string a little bit, let's say Silver Lake Partners has a deal they want to take down. They want to put 40% of the equity in their Silver Lake Partners 8, and then there's 60% left over that they spread across kind of co-investment, first primarily to their LPs who get to choose here, there, the other, and then JP Morgan has a unique relationship with Silver Lake. I'm making this up, where they get exposure to some incremental, whatever's not taken by the LPs of the Silver Lake fund. JP Morgan has that exposure. So JP Morgan is you've got Silver Lake doing the diligence that the deal makes sense. You've got JP Morgan who accessed the relationship with Silver Lake and did diligence on top of that. So both on Silver Lake and on the underlying company. And then you guys internally on top of that, right?
I would say correct. Internally, it's when we cross certain threshold. So assuming the ticket size that we give JP, say $10 million, they can approve anything under 10 million. If they want to approve anything above 10 million, they come to us. So
who makes the decision though, when you've got 6 of these opportunities from different sponsors or the same sponsor? How do you come to arrive at, how much you allocate to each of those six opportunities? Do you know what I mean? Like, let's say,
yeah, understood.
There's $10 million. There's a $10 million piece of cake, and there's 10 of those $10 million pieces of cake. How do you figure out which ones you take and which ones you don't?
So I would say the first layer, assuming that we approve that the underwriting at JP Morgan passes, and it passes their investment committee, then we wait for the allocation. Good deals, Jay, you don't get even the 10 billion. So what happens is you take what you get. Sometimes when there is an extremely attractive deal in a sector that we believe has tailwinds, and in expertise and the underwriting of the GP is extremely conservative, and we know the value add that can be done to the company, we tend to top up if we are getting if we get the allocation. So I would say in a perfect world, we will get the full allocation, but unfortunately, good deals you don't get.
Yeah, that's I guess what I was getting at is adverse selections, right? The really good deals don't find their way to JP Morgan, right? They're consumed by the LPs of Silver Lake. And I think it's an offline discussion. It's not germane to what we're doing here. The point bringing it back to what we're doing here is just, if we've considered that unique approach where we're picking which co-investments we're making allocations to, is that reflected in the volatility assumption in our long-term model? And it sounds like we don't have any reason to believe that the volatility is different than what NEPC's beta case is. And that's how we're, Samar, I think I want to talk offline with you about this.
Yeah, sure.
To understand. But
one thing I want to clarify is that JP Morgan is not doing this for us on a one-off basis. They've been doing it for themselves for 20 years, right? So they know all these GPs, they know the funds inside and out. They know when a co-investment's coming because they're looking at it for their own funds as well. Sure. So this is something that's going through the lens of their expertise and also really ours for portfolio construction. Because the co-invest ends up kind of being additive to the overall construction of the private equity. So there's controls around that. Another control really ends up being pacing. There's only a certain budget that can go to co-invest, right? So that helps moderate, mitigate, wanting to take every single deal that's out there. We can pass on it if we know we have a budget. We're trying to then just diversify over the course of the year and then kind of pick the best over time. And that's hard to determine sometimes, but it's generally there's a pacing to it.
I got it. Okay. I won't beat this issue up anymore. I wanted to just understand what our implicit assumptions in the long-term kind of model are, and that makes sense. So I appreciate the deep dive from everybody. Thank you.
Of course.
So I think in the interest of time, the recommendation here in terms of the asset mix is a staff mix that really takes the private equity allocation to closer to the actual allocation now. Same thing with credit from 23 to 22. And then real estate coming down a couple percent to accommodate those two increase in or the private equity allocation. So the staff mix, NEPC is supportive of the staff mix recommendation. I don't know if you want to take this separately, but this is a recommendation just on the allocation, and then we have a benchmark recommendation.
I'm fine taking them both as one. I think from the materials in terms of the approval and the motions, I'm fine taking them both as one. So maybe if you want to just address the benchmark
Sure.
issue, which I think, as you guys know, I'm going to be very supportive of this because I think we spend a lot of time in the discussions talking about performance relative to a benchmark that's not entirely appropriate and or not entirely apples to apples. I'm not saying it's not appropriate, but apples to apples. So I love that direction, and I think it's going to be a relatively tame, it's going to be an easy approval, but why don't you lump them together and articulate that, and then we can make it as one motion.
So if we move to page 86. The recommendation here is to, for the two asset classes, private equity and credit, to change from your current benchmark, which is a public markets-based benchmark, to a peer universe benchmark. So for private equity, MSCI ACWI IMI 1 quarter lag, to the private equity North America Europe 1 quarter lag benchmark by MSCI. And then from the leveraged loan index based benchmark plus 250 basis point premium to the MSCI private debt US and Europe. So this is the same information you see typically in our oversight report as a secondary benchmark. We are making the recommendation along with staff to make this your primary benchmark.
So a little color behind it. So this ends up being an improvement. Obviously, everyone's kind of gone through this using public market equivalent relative to private market benchmarks. So this provides a direct peer comparison against other similar strategies, more accurate, and this is important, more accurate representation of the timing and structural characteristics of private markets relative to public markets, quarter lag that's in there, and comprehensive coverage of the geographic regions that match up to our private equity and credit perspective. So we're able to choose the most appropriate private market benchmark for us. And these are the two that we've been utilizing in the NEPC decks over the last 2 or 3 quarters. And now we just want to make the change official.
Kevin or Diane, any questions, comments here or anything you want to dive deeply into on the benchmark changes?
No.
Paul, this is Kevin. I don't have any questions. I did want to let you know that I've got a hard stop at 11:45. I don't know if I'm needed for a quorum to vote on this, but and we'll hang on as long as I can, but just an FYI.
I think Kevin, I appreciate that, and it's probably shame on me for going so deep here on the question. Sorry about that, but I think we've got one. This is the item to vote on. And I think if we, barring anything else from Rose or from staff, I think we're prepared to vote on the kind of asset allocation or the asset liability mix, asset allocation, and this benchmark change in one action. Now, if we don't have any administrative issues that would prevent us from doing that. Is that okay? Can we move to a vote?
Yes, absolutely. Thank you.
Okay, what I would say with respect to agenda item number 4, the current asset liability study, do we have a motion with respect to the staff recommended allocations and the changing of the benchmarks?
Yes. I move that the investment committee recommend to the board the ASRS staff recommended asset allocations, benchmarks, and implementation dates as follows. Public equity allocation of 44% with a range of 34 to 54% with the benchmark of the MSCI ACWI IMI net USA gross. Private equity allocation of 13% with a range of 10 to 15% with a benchmark of the MSCI PE North America and Europe quarter lag. credit allocation of 22% with a range of 17 to 20%, 17 to 26%, with the benchmark of the MCSI Private Credit US and Western Europe quarter lag. Interest rate sensitive allocation of 6% with a range of 3 to 12%, with the benchmark of the Bloomberg Treasury Index. Private real estate allocation of 15% with a range of 11 to 19%, with the benchmark of the NCREIF ODCE index quarter lag, and with an implementation date of July 1st, 2025, or another date as determined by the ASRS Executive Director based upon investment market conditions and implementation practicalities.
Ms. Landis, I was going to make a joke and ask you to repeat that, but I won't do that.
Wise.
Thank you for that. And do we have a second?
This is Kevin McCarthy. I second that.
Great. Can we take that to a formal vote?
Hearing a motion by Ms. Landis and a second by Mr. McCarthy, I will take a roll call vote for the motion to approve the current asset liability study as stated. Please answer aye or nay when I call your name. Mr. Petkunis.
Aye.
Ms. Landis.
Aye.
Mr. McCarthy.
Aye.
Chairperson Petkunis, the vote has been taken.
Thank you very much. Any other comments on item number 4 before we shift to item number 5? Okay, let's move to item number 5. I think, Mike, this is in your court.
Yes, thank you very much. For the record, Mike Viteri, Chief Investment
Thanks,
Officer.
Rose. Thanks, Rob. Appreciate all your time. Sorry.
For the record, no, it's okay. CIO, Arizona State Retirement System. As Al, John Trusiak, and Mike Copeland come on up, we're going to go ahead and start with public equity. Cole is joining us virtually. Cole, if you want to go ahead and kick it away. We're starting at page 118 of 199.
Yes, thank you, Mike. And first of all, my apologies for not being there today. I'm a little bit under the weather today, so I'm just doing this virtually here for now. Excuse me. So first of all, for the record, my name is Cole Smith, Senior Portfolio Manager here at ASRS, and here to present the public equity asset class. At any time, please stop me if you can't hear me well or if you have any questions. So here we present our performance as of December 31st for total public equity. We have total in the top table, and we break it down into domestic and international in the next 2 tables. So regarding total public equity, we did have a great year in 2024, posting a total return of nearly 17% for the asset class. This does help to boost our trailing returns, and the long-term performance is consistently above the 7% required rate of return for the total plan. Regarding the excess returns, we have made tremendous progress since we changed our investment strategy about 5 to 7 years ago. If you recall, over the course of 2018 through 2020, we did remove some active management and factor strategies that were consistently dragging down our returns. At that time, we did adopt an enhanced indexing methodology to our equity portfolios. Now, essentially, this means that we just take very little active risk, what we call tracking error, and we try to compound these small but positive excess returns. Now, since we made this change, we have had positive excess returns in every calendar year since. The trailing excess returns for both 1 year and 3 year are positive, and we hope the 5-year excess will turn positive later this year, and if not this year, then hopefully next. Of course, we're going to continue to chip away at that 10-year excess return as well. Looking at the next 2 tables, we dig into U.S. and international. You know, just like I've been saying, probably these last few meetings, we see that domestic equities have really outperformed international equities across all time horizons. And for the record, our total equity benchmark, or total public equity benchmark, is about 67% U.S. and 33% international. So this U.S. outperformance has really helped us, given the way that our benchmark is actually constructed. That's all the prepared comments for performance. If there's no questions, I'll move on to page 120, 199. Thank you. And here we just have some summary statistics for the asset class. So total public equity is still the largest asset class in the total plan. We're just shy of 44% as of December 31st. 2/3 of this asset class is managed internally across 8 portfolios. The other 1/3 of it being managed externally by 2 indexing managers like ourselves. In the top right, we see that we are in line with our benchmark in terms of both regions and size, with no real active tilts to speak of in any location. In the bottom left, we see the sector weights that make up the benchmark and thus our portfolio. As with prior quarters, technology sector has been the largest weight, followed by financials and then industrials and discretionary. And now on the bottom right, we show our top 10 holdings by weight in our benchmark. Again, with prior quarters, the names of the list here pretty much remain the same, although they do tend to shuffle around a little bit. But these names do constitute what's been referred to as the Magnificent Seven, like what Rose and Rob had referred to. If you add in Broadcom and Taiwan Semiconductor, you round off these top 10 holdings in our benchmark. So again, I feel like I'm going a little quickly. Please slow me down, or if you have any questions, just please let me know. Great. If we could move on to our house views then, please, on page 122. Just one sec. Excuse me. So, thank you. As a slide states here, we had originally projected the S&P 500 might end 2024 as high as 5267. Now, in our minds, at the end of 2023, that would have been a great return. However, instead, it posted a total return of 25% for the year, ending near all-time highs at about 5881 on the S&P. There were a couple turbulent moments throughout the year, of course, such as in April and in August. The market shrugged these off for the most part. Now, post-election in Q4, markets did exhibit some rotation, and it was primarily away from these market leaders like the Magnificent Seven and other tech and consumer stocks. But the rally did resume at the turn of the year, and we reached new all-time highs on February 19th. But since that date, uncertainty over policy, concerns about economic growth have really reintroduced volatility. And we actually just recently had our first 10% correction since late 2023. And the second paragraph, I mentioned concentration of a handful of companies within these market cap weighted indexes like the S&P. Concentration is a risk, and this recent correction really showcases how it can exacerbate these market drawdowns. It's especially true for stocks that have richer valuations, such as the Mag 7 did leading into this. But since this correction, we've rallied nearly 5% off the lows we saw on about March 13th. Despite this, we're still in negative territory for the year for U.S. equities. And I say U.S. equities because, however, international markets have done exceedingly well to start the year. Developed markets, especially such as those in Europe, have returned over 10% this year, while emerging markets are even up over 5% on average. And I mentioned in that performance slide, U.S. markets have been dominant for so long, but this leads to valuations that have become relatively stretched. And the rotation to non-U.S. equities this year has helped close some of that performance and some of that valuation gap. And this has even led to discussions about how perhaps we've reached the end of, what they call a U.S. exceptionalism when it comes to public equity markets. This does seem premature, but we definitely cannot discount the growth story of our international peers that seems to be emerging now. And looking ahead, consensus still expects positive returns for equity markets by the end of 2025. Since this slide was produced just about a month and a half ago or a month ago, earnings and price targets have been slightly reduced by analysts given all the volatility, but the median projection is still for markets to end the year above 6,000. Right about 6,300 is the current median when we measure that by the S&P, which is a great return from here if we can achieve it. So, and if we can move past some of the policy uncertainty and instill confidence back into the economy, then we would expect earnings to continue growing just at a smaller pace. And that would actually support higher equity prices by year end.
Hey,
So
Cole,
forgive me for being so quick, and that's all I have. Yes, please, Jay, go ahead.
well, on that kind of 6,300 to 7,000 market, analyst range, is that our house view? Do we expect, are we consistent with that view, or?
I would say our house view is closer to 6,000, and Samara, if you want to correct me if I'm wrong. Whenever we first saw this target, we were a little bit uneasy about these high ranges, given that the last 2 years back-to-back market returns of over 20% in the S&P 500. It's hard to do this 3 years in a row. So when we saw, we saw analysts putting these numbers out that, hey, we could end up at 7,000, another potentially 20% return for the year. We were a little bit uneasy with that. And, and I even, the last sentence of that last paragraph, it says, caution's warranted. But I believe 6,000 from here is achievable. It can be somewhere around between an 8% return. It seems that perhaps most of the malaise in the markets will be front-loaded this year, and we're hoping for a better second half of the year. So if I had to, put me in a quarter and say where will the year, I would hope we can achieve 6,000, which would be a modest return on the S&P.
Great. Thank you.
Of course. Thank you, Jay.
There's no other questions. If we can move to Samer, please.
Good morning again, Mr. Chair and members of the committee. For reference, my name is Samer Gadar, and I'm here to present the private equity. If we can move to slide 126 of the deck. In this slide, I will just because it was mentioned in the NEPC report, our returns versus the MSCI ACWI, which is the public markets with 1 quarter lag. I will focus on the second table on the top of the presentation, which is the IRRs or capital weighted returns or cash weighted returns. You can see that on the 3-year basis, we're still outperforming. On the 1 year, we're slightly off, and that's mainly because of the second quarter of last year. The market rebounded. If you remember, when I presented last time, I said our portfolio did not go down the same way the private equity market went down the last 3 years. We outperformed, but the private markets did catch up in that quarter, and we underperformed. The last quarter, which is the 3-month ending September, we are slightly lower than the benchmark, but we are, I would say, on a go-forward basis, we should be in line. The graph shows our returns on IRRs and TVPI and distributions. Distributions have been stable, but we do expect that this year will be higher, and I will go through it in a minute. If we move to the second slide, which is on page 127, in this slide, it shows the cash flows of the portfolio, and the cash flows in terms of contributions, meaning capital calls, and distributions, meaning exits from our GPs and our accounts. It's almost on par, meaning distributions are technically at equal to capital calls, which is extremely helpful for our allocation, and it means we are going through the right direction and our portfolio is mature. We do expect this year, if things go the same way as we've seen the first quarter and the last quarter of 2024, that distribution should be higher. It all dependent on how the markets react. So far, activity in Q1 from January to, I would say, to yesterday, it's been the busiest on deals we have ever seen in our portfolio. So capital calls have been extremely high and probably the highest historically on Q1 and throughout our history from 2006 to date. And that is a positive move that we are hoping that should be reflected in distributions.
Wow.
Yes, sorry.
No, I said, wow. So big Q1 so far.
Yeah, big Q1, especially. And this is interesting because I've never seen such M&A activity. And I was joking yesterday that there's a lot of credit in the market. So if 2 years ago or like 12 months ago, if you wanted to fund a deal, M&A deal, it would be really hard to get funding. Now you get a lot of term sheets. When I say seriously, a lot of term sheets.
Is it because the capital has just been sitting on the sidelines for so long because of maybe the transition in kind of government and all of these things? What do you think is really driving that kind of appetite for debt capital?
I think there's a combination, Jay. One of them is a lot of private debt have been raised and was sitting on the side. The second one is stability in interest rates. Although the economic, I would say the policy change is still a bit foggy, but in terms of stability of interest rates, it's allowing, especially on the private debt side, more visibility on transactions. And to be honest, even on the M&A side, valuations have been more reasonable compared to stubborn valuations a year ago or 24 months ago.
Got it.
On this slide, which is page 130, I just want to focus on one thing. If we go to the fourth column, which is our combination of first quartile and second quartile, and since the inception of the portfolio, which is 2006, you can see 1 year on, 1 year off. And this is very important because the difference between first quartile and fourth quartile is around 20% in IRR. So choosing the right manager or the right GP, right strategy, and choosing a tier one a manager or top quartile versus a fourth quartile, there's a huge difference. So underwriting is extremely important. And since we took over the portfolio and changed our strategy, you can see 2019 onwards, average is above 55% in terms of selection of first and second quartile. And that's very important. It doesn't show on the short term, but it should start showing soon. Now we're outperforming on the 3 years. We expect that to become the 5 years and hopefully in a couple of years on the 10 years and on the inception year to date. And so I will stop here if there's any questions before I go to house views. If there's no questions, I will move to slide 132 on house views. So I did discuss a bit of this early on. So our portfolio is mature. We try to focus on the mid market, and that's compared to historically we were more on the large cap market and sometimes the mega cap. And there's a big difference. Usually when funds become too big, they become the erosion of returns become obvious. So the mid market, there's a wider range of a spectrum of companies in the US and Western Europe, and the capital availability is lower, which means there is more attractive assets to pick and choose versus the large cap deals that are a handful of players, a handful of assets. So we like this segment of the mid-market. We like sector-focused strategies, meaning the GP is an expert in their sector. And if we cannot find an expert in the sector, we like a multi-sector manager that have a focused team on each strategy. And it's the same what we've mentioned in prior committees. Tech, healthcare, industrials remain our focus, and they will stay the same on a go-forward basis due to the secular trend that we are seeing in the market. We also like the operational approach. We stay away from financial engineering, and that's been what we've seen in our portfolio. Financial engineering, when interest rates go against you, you will have a lower returns, and when you have operational value add, the returns will be more consistent. If we go now to what we've seen the last 2 years and what we expect for this year, the last 2 years, I would say, activity have been slow. It's picking up, but slower than expected. The key driver for this pickup have been, as I said earlier, stability in interest rates, meaning the Fed is not increasing interest rates anymore, and it's showing that they have tendency to cut rates that started last year and expected to be a couple of more times this year. And the other one, which is inflation, although inflation headline inflation is still higher than 2% project policy at the Fed, but we do see inflation stability. However, the flip side of things is a shift in economic policy that's still not clear how it's gonna affect deal making. If that goes the right way, meaning stable, we expect activity to pick up in 2025 and 2026. On the exit activity, there is more exits, but I would say sponsor to sponsor, meaning a private equity to a private equity, and less so on the IPO market. We do expect IPO market to do better as long as the public markets stabilize. And to go back to what Cole mentioned, if the market digesting everything in policy change this first half and stabilizes the second half without entering the economy entering into a recession, we believe that IPO activity will come back. I'll stop here if there's any questions. Otherwise, I'll give it back to Mike.
No questions from me, Samer.
Thanks.
Thank you very much, Samer. Let's move on to real estate asset class. Mike.
Thanks, Mike. Good morning, Mr. Chairman and members of the board. So my name is Mike Copeland,
Morning.
Team Portfolio Manager of Private Markets. So if you go to slide 136, I think rather than focusing on quarter over quarter changes, it's important context, take a step back. So the last 2 years, the real estate cycle has been down since the peak. Our since inception return for the real estate portfolio has dropped to 5.5% versus I think it peaked around 10.5%. This down cycle has been the worst in real estate since 1988. And while every cycle is different with different causes and different ways in how it plays out, there are a lot of similarities to that decrease, with a massive change and shift in debt availability and an oversupply of major property types. And so it's similar here in multifamily industrial, seeing record demand, record supply, new supply coming in. Last year, peaking last year, with a significant drop off in new supply coming towards the end of this year and into 2026 and 2027. Record absorption last year, but given the new supply, vacancy increased to around 9%. Our portfolio has outperformed across every time period with the exception of the 3 months. It's really driven by our approach and structure and our overweights, which I'll get to in a couple slides. And looking forward, the benchmark had a flat return at 12/30 or at 9/30. When you see the 3/31 numbers, the benchmark was positive for the quarter, which is the first time in I think 16 quarters that's been the case. And we expect our portfolio to have a similar positive return in the fourth quarter. As a reminder, we get all of our assets appraised on an annual basis at 12/31, which feeds into the 3/31 performance that you'll see. And cap rates have stabilized. There's positive income growth across the portfolio. And we have and our investments in the data center space will be marked up by to 2x from 1x at quarter end, given the success of our partners' capabilities. And we also expect increased transaction activity this year. Anecdotally, if you flip to the next slide, 137.
Mike, one question before you go to the next slide. Just 2 quick questions on the prior slide.
Of course.
On the real estate operating company side, obviously the significant outsized IRR there. What percentage of the book, give or take? I mean, how big of a piece of the pie is that? The real estate operating company?
It's 6% of the portfolio.
6%. And then in terms of valuation there, that's more like an enterprise valuation than it is a real estate valuation. Is that right?
Correct. Those are private equity investments. We're investing directly into the operating company.
Yeah.
We have 3 of them, and so the valuation is it's a combination of the underlying real estate valuations. The GPs are 2 to 10% of the underlying real estate they invest in, plus their accrued promote of those investments, and then a valuation of the operating company itself from the various fee streams.
Yep.
The company is generating.
I got it. So it's influenced by the underlying real estate value in the form of marking the promotes to market and their co-investments that they make, which you said is 2 to 10%, and then there's just that ongoing enterprise value. That's a third component, but that's all. I got it. It's 6%. If you told me that was 15 or 20%, then I think that might be a little bit more skewing of the returns relative to the index, because I don't think you've got operating companies in the index, but that 6%, that all makes sense. Thanks.
Yeah. I mean, and the other thing is the debt component, which is currently around 11% of the portfolio.
Yeah.
And that's also not in the index.
And the 6% of the real estate operating company has all the look-through underlying real estate benefit, i.e. the co-investments and the promotes in that 6%, right? So it's not incremental. You're not showing the co-investments that your operating companies make in a separate line item. That's all lumped into that bucket, right?
Correct. Yes.
Okay. Yeah. So the enterprise value component of it's going to be something significantly less than 6%. Said differently, the underlying real estate related to the co-investments and the promotes moves in the same direction as the rest of the book, the operating company piece is an even smaller percentage of the overall pie.
Yes, that's accurate.
Okay, got it. Thank you.
Of course. So moving to the next slide, which is 137. I think this is an important slide to highlight, especially given the dynamics of the markets. The past 2 years, transaction volume is down, I think, to multi low since the great financial crisis. So year over year, I think 2022 was down, or 2023 was down 80%. 2024 is down 75%. We are seeing increased activity in the transactions, and through our structures, we've been able to generate cash back to the, coming out of the portfolio. We've done that in 2 different ways. One is just selling assets. So we were able to sell a large industrial portfolio in December. If we took that to market 12 months ago, we'd have seen maybe 4 bidders, probably pretty aggressive pricing, because they'd be solving for, fast forward 12 months, we were able to get, I think there was 12 initial offers on that portfolio, and then 4 to 5 in the final bidding round. And this also shows the benefit of the operating company investments. Our partner sold it to as a recap. So an opportunity fund came in and bought the portfolio and then made a commitment to our operating company partner to acquire more assets to build out that portfolio. And so ASRS will benefit from both the sale in the form of 140 million of distributions, as well as the incremental promote generated from that new venture, and the management fees generated from that new venture, which is highlights our structure. And we also did the CMBS market has been very active, and so we had a large portion of our industrial portfolio was under levered, and so we raised a CMBS transaction to take out debt, lever it up to around 50%. And that generated about 170 million of proceeds. And so we're doing things like that in the portfolio to get to, to reach the target of 17%, which did happen before the equity drawdown. But it's around 17.3% right now. And then I think stemming from a question from the last board meeting, if you go to page 139, 138 and 139 show our portfolio relative to the benchmark. So the biggest change that we have relative to the benchmark, I'd say, is on 139, which shows by property type. As a reminder, 50% of we have a target of 50% to multifamily. So if you take the apartment and a little bit of the other, that's the rental housing component, and it is around 51% of the portfolio. And it's a significant overweight relative to the benchmark. The industrial portfolio, we're underweight right now. I think we peaked at 30%. And given the transaction, the liquidity market, the industrial was a property type that you could sell and at an attractive closing price relative to other property types. We sold some industrial as well as the CMBS transaction has reduced that, but we expect to, over the next 12 to 18 months, get closer to that 35% target that we have for industrial. Any questions?
Yeah, Mike, what's your plan on a long-term plan with respect to office? Can you refresh my memory what the target is? I see where we sit relative to the benchmark, but what's the current target and what's your plan long-term?
The target is 15%. The way I think about our approach to office is that it's a trading asset. So you find an asset that you like, you put some capital in, lease it up, and then sell it. And you just rinse and repeat kind of that strategy. The other thing is on the life science side, I think the market for that is very challenging. But looking forward 3 to 5 years, like 3 years, I think life science would be a big component of that office portion. But I think 15% is likely the peak. Like it will probably be within 10 10 to 13%. It's going to be an underweight, but that depends on how much we're able to move into industrial and data centers.
Got it. Okay, helpful. Thank you.
Yeah. Any other questions?
No, thanks, Mike. I'd like to move to the Godfather credit, Al Limo next.
Well, thank you, Mike, and good afternoon. Al Limo, Deputy CIO. Talk about our credit portfolio. If you go to page 146, please. Yeah, just to talk about the performance. Let me talk about the long-term performance. We've exceeded the return target of the total fund of 7% and outperformed that overall periods. We've underperformed our benchmark, which is this S&P LSTA. Morningstar LSTA Leveraged Loan Index plus 2.5%. It's a floating rate index that we're not invested in it. We've underperformed it for the 1 and 3 year period. It's had a massive rally in the past 2 years, and we're just not designed to keep up with that kind of performance. The second factor that probably limited our performance in the 1 and 3 year period was just some underlying losses in some select portfolios of deals done pre-COVID. And it affected a couple of US lending partnerships, one European lending partnership, and a couple of distressed debt partnerships in Europe, all unrelated reasons, but they did dampen our performance. I am optimistic that not in the next board meeting, but in the following board meeting, IC meeting rather, when we report our results for the March 31st actual quarter, which is the last quarter of fiscal 2025, that we'll see significant outperformance of our portfolio relative to this benchmark that we're moving away from anyway. But that benchmark is down about 0.8% through the almost at the end of March now, and we should meaningfully outperform that. So it'll become a moot point since we're switching benchmarks. It's just approved with the new SAA.
So Al, the irony is that you've had to be measured against the old benchmark while it outperformed, and now we finally changed the benchmark and it's coming down, right? I'm sorry for you on that one. We should have helped you sooner. We should have helped you sooner.
That is correct. I just will have to explain less going forward, so which I do appreciate. I do think moving to that new benchmark makes a lot of sense.
Yeah, but I guess the point, I think what I heard you say though is even if you were measured against the old benchmark, a couple quarters from now, you'd be okay, right?
That's exactly right. I appreciate that.
Sorry to laugh at your expense.
Yeah, no, it's fine.
It feels like though the new benchmark is going to make our conversations a lot more focused on our existing book versus trying to, compare apples to oranges on the old benchmark, which I think will make it a lot more productive.
Yeah, I think it's a great move, and that benchmark was not available to us in prior SAAs that we've had the credit exposure. So it's a nice addition. So let's move on to page 147 real quickly. Just shows the history of the asset class. You could see the growth in the portfolio from total credit asset class. When we created it in 2018, it's grown from 6.6 billion to 12.4. We're just under our target right now is 23%. And we're a little bit under that at 21.9%. And that's primarily due to the growth in public equities and a little bit of dampened deployment. Moving on to page 148, just showing
Al, one quick question though. This is probably for you and Mike on the real estate side. I remember there being some real estate credit on the real estate book, but those are funds? I can't remember the distinction. There's a little bit. Do we have a little dose of real estate credit that's in the real estate book and not in your book? Is that right?
Yeah, that's a great question. The answer is yes, but we're going to address that. And with the implementation of the new SAA, we're going to reallocate one or two partnerships that were real estate debt. They're on real estate over to private credit. And then we're going to cease investing in one strategy we had doing preferred equity and credit. And that will be assumed in an existing partnership that real estate has. So we're going to clearly delineate between real estate debt being solely in credit and anything that's preferred equity and above, or preferred equity and below rather, preferred equity or equity is going to be in real estate. We'll have to work through that in the implementation, how that's going to be accomplished. But the goal is to reallocate those funds to have a better classification.
So pref equity and equity is in real estate, senior, and if it's mezz without control is in your book then going forward? Is that how that would shake out?
That would be correct. That's
Got
right.
it. Thanks.
That's a great question. Thank you. And then going on to page 148, just going to touch on this. These are the cash flows for credit. I just want to point out in the last 2 years, 23 and 24, that our distributions from credit have been well in excess of our contributions, even though we've grown the asset class as shown on the prior slide. And that's the result of the income stream coming from our direct lending partnerships, which are roughly 2/3 of our credit asset allocation. They throw off a large amount of cash flow that's distributed back to us. So it does provide a source of cash flow to the total fund to meet its overall needs. And then moving on to page 149, this is just a breakout of our sub strategies within credits for information purposes, but the majority of what we do is private debt or direct lending, and you can see the top three allocations: U.S. corporate on the left-hand side, European corporate, and real estate asset-backed are the majority of our credit exposure. And last year, our view on this is on page 51. Our view on credit is still positive in terms of opportunities to allocate to the asset class and achieve our 7% return target and well in excess of that. We're working on several partnerships in credit that are either in various stages of due diligence or legal negotiation, and we hope to close in the coming June quarter, and then we could talk more generally about them in the coming IC meetings. And that's let's see if there's any other questions.
I guess I had just one question that's a kind of high level conceptual question. I know we've talked about higher for longer, but to the extent that broadly that rates start to come down, you know, say kind of if rates were to come down another 100 basis points from here, is your view that the spreads would expand in your business, or that you'd have a little bit of effective compression in returns with, you know, kind of correlating with rates coming down?
It's a great question.
I know it's a really general, broad question.
Yeah,
I'm more looking for a gut check, you know, like if.
Yeah, I'd almost rather answer that this way. It's not really directly answer your question the way you're asking it. Well, yes, all things being equal, if base rate in the U.S. fell by 1%, it would hurt some aspects of our portfolio without any movement in spread. That being said, we're seeing a lot of opportunities beyond U.S. direct lending that are going to generally be immune to that. So, and also we've found ways in which to lever our partnerships at higher levels that could help offset that impact of return. I'm not sure where spreads are going to go. I'll say in U.S. direct lending, it's a more mature market now than it was several years ago. And that's because of new entrants and a change in some of those new entrants High net worth individuals have been able to access the market through some structures, starting with a fund called B Credit at Blackstone, that have turned the normal way of investing in private credit on its head, simply because they attract capital from high net worth individuals. The money comes in, and then they are pretty much forced to invest it. And they become, in my view, irrational players in the market. And that is in contrast to how our credit portfolio has been built through private partnerships called the institutional market, which is similar to private equity, where an institution will make a commitment to a partnership, and then the general partner or manager will then find deals that are attractive and call capital. It's a difference between a push and pull. And I will say that the U.S. direct lending market has gotten some spread compression simply because of that change. And that could potentially, I'll let private equity talk about it, but that you hear stories that they're trying to turn that on its head a bit, I think, in private equity as well. But we're seeing that in credit in the U.S., not in Europe, not in asset-backed finance, not in the areas of other credit we're invested in, but just simply in U.S. plain vanilla direct lending.
It's funny, Blackstone's doing that everywhere. That you got B REIT, B Credit, that you've got the long tail of investor appetite from the high net worths that then are really spot buyers and probably bidding down spreads and bidding up real estate prices on the B REIT side, right? So it just makes your life harder. Is that what I'm hearing? Basically?
Yeah, that's right. I don't think people managing high net worth money of that type are good fiduciaries.
Yeah, to your point, it's that they're more focused on deploying the capital than and you have less times in the cycle they're sitting on the sidelines. They're spot buyers to deploy the capital, right? We're seeing the same thing in real estate too, right? With B REIT, periodically over these kind of fits and starts. So interesting. Got it. Thank you.
There's no further questions. Move on to John Trusiak. John?
Hey, John.
Thanks, Mick. Hello, everybody. My name is John Trusiak, Portfolio Manager for Public Fixed Income. If we can move to page 155, please. So I first want to just point out a couple things about this slide. One in particular is the performance over the 1, 3, and 5 year period. You can see it basically ranges from a little bit above zero to a little bit below zero. So why is that important for how we weight this asset class, which is a 6% SAA weight and a 5.3% interim SAA weight? We're currently at 3% for the total fund. And the reason for that 3% is exactly due to that 1, 3, 5, and even the 10-year performance of roughly 1%. And that does not meet our rate of return we're seeking for the total fund of 7%. And I'll get to this on house views, but I just wanted to point it out on this slide. That is why you continue to see on that bottom right chart our current allocation of 3%. And I will touch to the fiscal year to date underperformance of 2 bips versus the benchmark. We've taken what happened there for the 2 year, or I'm sorry, the 2 bips underperformance is a little duration mismatch when there was momentum on rates moving downward and then momentum on rates moving upward. Happy to say that if we were to look at the performance as of today, we are in the positive category against the benchmark. Next slide, please. And here I'd like to point out the bottom left, the yield to maturity of the benchmark and just how volatile it has been the last 2 quarters. So you can see the September 2024 yield to maturity dropped all the way to 3.77%. And then escalated at the quarter we're looking at, year ending 12/31 up to 4.45%. So that volatility was drawn by many different factors, some of those variables, including the election, and then also the government deficits and also new issuance of treasuries to the market. And then for portfolio sector weights, we still are predominantly a U.S. Treasury portfolio with over 91% in treasuries. And then, of course, we are allowed a tracking error, which allows us to invest in non-index securities. What we've been sticking to are very high grade corporate bonds, rounding out the internal portfolio. 2 slides, please. And I'll finally wrap it up to just what I just summed up, unless I'm hearing any questions. Okay, not hearing any questions. So as I pointed out, we did have 2 basis points of underperformance for the quarter ending, year-to-date ending 12/31/2024. Like I did mention, if you look at it today, we are in the positive territory and we'll continue to push that trend, hope to do. And then, like I also did mention, is that 3% asset allocation for this asset class. It's well below the 5.3% interim, but we continue to take a house view that that's the appropriate lower bound range for this asset class due to it not meeting the fund's desired rate of return of 7%. And then we continue to say that these interest rates, the interest rate market continues to be volatile. Right now, if you look at the SOFR futures curve, it is based off of 50 bips of interest rate cuts from the Federal Reserve throughout the remainder of the year. We do view that as a base case for this asset class and for the global macro rate environment for U.S. Treasuries. However, if you had taken that same SOFR forward curve and looked at it a couple months ago, there was close to 75 bips of rate cuts priced in. So it continues to fluctuate what the forward rate curve market is basing how many cuts will be this year from the Federal Reserve. But we continue to say the phrase higher for longer interest rate environment. However, that higher for longer interest rate environment should be looked at relative to where rates were 3 or 4 years ago, which, you know, as everybody knows here, it was a 0 interest rate environment. So we do believe that interest rates can and will likely come down from where we are today to the tune of 50 basis points by the Federal Reserve. But we believe that that can stay elevated relative to where we were 3 to 4 years ago. And finally, I'd like to just quickly touch on where spreads exist in the corporate bond market, where they continue to stay at historical tights. Over the last couple of weeks, they have moved upward some, but have really restabilized. And due to that, for our non-index security purchases of corporate bonds, we continue to view a cautious approach and stay in high grade, low duration corporate bonds for our non-index securities and stay well within our tracking error constraint. And with that, I can take any questions. And if there are no questions, thank you for the time.
Thank you. Thank you. No questions here. Diane, any questions?
No, thank you.
Yeah.
Thank you, John. All right, we'll move on to page 161. Updating performance through January 31st, so just rolling forward 1 month. The market value of the portfolio as of January 31st is 57.3. So that's about a $500 million increase from December. If we look at the top line, we look at the 1 year, 3 year, 5 year, 10 year, and 20 year numbers. All performance, all absolute performance there has been in excess of the actuarial rate of return, with the exception of the 3 year number. If we look at excess numbers, excess return numbers, the 1 year still has a -3 handle on it, but the 3 year has gone up about 26 basis points. I'm sorry, 32 basis points from December. December was posting a -12 basis points. Now this is a 20 basis point excess return. And we've seen increases in the 5, 10, and 20 year period. Now it's always unfortunate when we have a year, in the case of the 3 year, that dips below the actuarial assumption rate. We'd like to always have those numbers are above. But if we could turn to page 28, please. Kind of want to highlight the market dynamic there. 28, 28. We're going back to the NEPC presentation. Thank you. So you'll see the 3-year return. This is for December, not January, but 4.77. But look to see where our percentile ranking is, 6%. I don't think there's any conceivable way that we could have cranked out a 7% actuarial return had we invested in other asset classes. So I'm saying, even though we're under our actuarial assumption, and this is again for December 31st, it was a pretty good outcome relative to our peers. So that was, and this goes to, I'm kind of always saying, we're price takers, not price makers. We can't force the market. We can only do what we can do, and on a relative basis, competing against all of their public pension plans that are bigger than $1 billion, this is a great outcome. So that concludes my comments. Thank you very much.
Thanks, Mike. I think that concludes section 5, right? Or item 5.
Yes, sir. We move on to Mr. Robert Butler next.
Sounds great. Hello, Robert.
Hello, I'll try to go quick and so everyone can get to lunch. For the record, Robert Butler, Investment Risk and Compliance Officer. I'll start on page 164. Summary slide, and just a reminder that this is based on our portfolio holdings as of the end of the year, 12/31/24. And I'm going to go pretty quick in the interest of time, and because our heavy allocation to privates, a lot of the stats don't move too much quarter to quarter. So if I skip anything, yell and I'll go back.
Will do.
All right, so skipping to page 169. All right, and here we just show the correlation of our different asset classes. I guess green being good, meaning lower correlation. And so a reminder, correlation is a measurement of movement of two assets related to each other. And so when you're constructing a portfolio, it's helpful to have a mix of assets that don't all respond the same to economic situations, and it helps smooth out the returns. And on page 170, on the left, we show our asset allocation by kind of dollars invested. On the right is the contribution to volatility. And so you'll see that both public and private equity contribute the majority of our volatility. But as noted previously, it's a lot less than kind of you would see in a, that's not good English, apologize. A lot less than you would see in a 60-40 portfolio, where you have 60% invested in equities and 40% invested in bonds. In those portfolios, the contribution to volatility from equities is about 99%, where ours overall with both public and private equity is a little bit over 77%. And then I'll go to page 173. And again, I want to stress that this is based on our portfolio at the end of the year, 12/31/24, how it hypothetically would have performed in these past stress scenarios. And the light gray bars, if you can see them, is the outperformance of our portfolio versus our benchmark portfolio. And so you can kind of think of the gray bars as not just the outperformance, but kind of the value add from both staff and the consultants and the decisions made on asset allocation, as well as implementation, things like picking specific managers. Let's go to 177 next. And here we're just showing our largest public investment managers, where we, of course, are the largest manager, managing the U.S. equities internally, as well as most of the treasury portfolio, as John just shared. Then, of course, again, you'll note that BlackRock is a very large manager for us, and Legal & General is also a significant partner of ours. And on 178, we have our private markets managers by asset class. And you'll notice the heavy concentration with our managers in private credit and real estate, and a little less concentrated in private equity. But I believe the team's working on kind of narrowing our number of managers that we work with in this space to sort of preferred partners. We will jump to 180. And this is just the combination of our largest external managers for both public and private markets. And then again, I'll note that we are our own largest manager, managing about 32% of the portfolio across the US equities and fixed income. And that concludes my quick risk report, unless there's any questions.
No questions here.
All right.
None.
Then we'll go to page 185 for the compliance report. So there were no exceptions during the period under review for the pre-trade compliance system. And as the slide notes, that was December through February, but there also has been no, red flags since then. And then we'll jump to 189. And this is the report from our custody bank, Bank of New York Mellon. It's a monthly report looking at our portfolio compared to some of the state imposed limitations. There are no major exceptions reported during this time period of October 2024 through January 2025. The previous report to the investment committee covered August through September of last year. And then I did receive the February report a few days ago. And again, no major exceptions of concern. And then on page 190, this is just a summary of the private markets compliance review that RCLCO does for our real estate separate account programs. Basically, they are just reviewing the policies of our partners and double checking their calculations. And on 191, again, they've completed the review for the 2022 period, and the 2023 review process has started. So I hope to have more numbers next time as far as 15 completed, 10 to go, that sort of thing. But no major issues were noted. And then briefly on 192, Makita performs a similar review of our commingled fund investments. So primarily so private equity as well as private credit, even those are often the fund of one structures. But again, it's reviewing policies, double checking calculations. And on 193, they've got a few, lingering reviews to do for the 2020 and 2021 review process. And then the 2023 reviews have started. And part of the delay is there's always a delay because you got to wait for audited statements. And then sometimes some of the managers are slow getting back to them on certain questions. But we should have both the 2020 and 2021 reviews soon. And they've already started on the 2023 reviews. And that concludes my quick presentation. Happy to take any questions, or we can go to lunch.
No, I don't have any questions. Diane, anything from you?
No questions, thank you.
Okay, well, that concludes item number 6. I think we move to item number 7, summary of current events.
Yeah, and this is Paul Matson. I have nothing to add, but thank you for the opportunity.
Thank you. Okay, we'll move to item number 8, call to the public. Any?
We do not have anyone wishing to speak today.
Sounds good. Okay, item number 9, request for any future agenda items. I have none. Okay, hearing no requests, we'll move on to item number 10. The next ARS Investment Committee meeting is scheduled for June 25th at 9:30 a.m. And we'll move now on to item number 11, adjournment. I don't know that we need a formal motion, but I think we can we just adjourn. Thank you, everybody.
Very good. Thank you. Thank you, everyone.
Thank you.
Thank you, everyone, for attending. The time is 12:35 p.m.
Thanks.
Thank you.